This chip shortage is going to last longer than many people believe, likely straight through this year. And I wonder what that means for prices. Will this get worse before it gets better?
I don't know that it will get worse before it gets better, but there's no reason to believe it's going to get meaningfully better anytime soon. The Commerce Department put that data out yesterday, and what it showed is that there's a real shortage. Demand is 20% higher than it was a couple of years ago. There's a huge mismatch in supply and demand. Prices are high. Prices are higher. So what has to happen is we need to make more chips. Unfortunately, there's no easy solution. The solution is increased domestic manufacturing of chips, which is what we need to do.
A lot's happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Following the biggest two-day pop on the S&P 500 going back to April 2020, we come in a little bit. We're down a third of 1% on the S&P. On the Nasdaq, we're down 0.4%. The line from Russia on talks, any report on that they're going really, really well, particularly that Financial Times report in the last 24 hours. Russia saying on that FT report, it's wrong. Ukraine disagreeing too. So I think any hope for diplomatic breakthroughs, I think that hope got some cold water in the last couple of hours at least. The move back, though, is not a major move in the equity market. Resilient in the face of some real aggressive Fed talk too. Let's talk about what that means for the bond market. 2s, 10s and 30s. Last week on Thursday, the low of the session, 190.96. Not on 2s, on 10s. 2s are above that now at 192.41. We've seen a lot of work get put into the front end of the curve going into this first rate hike by the Federal Reserve since 2018. And we're starting to see things not just flatten out, but in parts of the yield curve, Lisa, invert. 2s, 10s, the gap between the two, about 20 basis points or so, call it 21. But the gap between the belly, let's say 3, 5, 7s out to 10s, kinks all over the place through much of this morning.
And underpinning this is this question of how long the transmission mechanism will take from tightening to an economic slowdown, and can the economy withstand it and continue to grow? And that, I think, the bond market's sending a message that's a lot more pessimistic than we're getting elsewhere.
You know what didn't get talked about much yesterday? Jim Bullard saying, I'll have 50, please.
Yeah.
The Bank of England, in about 30 minutes, remember Catherine Mann? She put her hand up and said, can I have 50, please? In the FX market, sterling, at the close when the Bank of England last hiked rates, was 135.98. It's come all the way back into 131.98, Lisa, on cable. Just wonder how sterling's going to match up to what we might hear from this Bank of England in 28 minutes' time.
I don't even understand the currency reaction, though, to the central bank reaction. I mean, honestly, even if you have a quote-unquote hawkish kind of proclamation, you could see a decline because that means slower growth ahead. Honestly, the currencies are responding to something other than simply tightening or loosening.
So I crowdsourced an answer yesterday on why stocks were up. I got about 200 different responses as to why stocks were higher. Does that explain anything to you about why stocks were up yesterday?
It explains that we do not know. That's basically the very clear message.
Do we ever know? That's the cross-asset price action. A man who might know some single names, some movies this morning. Good morning, Romain.
All right, John, that's a lot of pressure. Well, and to Lisa's point here about the bond market, we should point out that the equity market certainly has one eye on some of the signals coming out of the bond market and another eye, of course, on the fog of war coming out of Ukraine. You put that together here, and you got a little bit of a breather here on this day, coming off, of course, the biggest two-day rally we've seen on the S&P going back to April of 2020. The energy trade is reasserting itself today as we see crude oil over in London drift back above $100 a barrel. Occidental Petroleum up about 4% this morning. Schlumberger up about 2%. That's pretty much the big names, at least in terms of a volume basis, if you're looking for anything to the upside. To the downside, a lot of travel stocks moving lower here. Interesting downgrade over at Truist on a lot of the cruise lines. Big concern here that some of the bookings that we've seen for cruise travel hasn't lived up to some of the bookings that we've seen in land-based travel. Let's take a look at what's going on with the Chinese tech stocks. Remember, they had an amazing day yesterday. The ADRs here in the U.S. Alibaba had his best day on record, or I should say best day since its debut back in 2014, up about 37%. They're pulling back just a little bit here, down about 3%. There's still some concern that the rhetoric out of China with regards to the regulatory picture is still just rhetoric, no concrete action just yet. Apple shares and the stocks here in the U.S., the tech stocks here in the U.S., not so much a sell-off, but again, more of a holding pattern, down about 0.5%. That's pretty much the story for all the big mega caps. An interesting story on Netflix that we got yesterday amid the Fed meeting, John. They're actually rethinking their policy with regards to people sharing their passwords, testing out a program in a couple countries that could make you pay to share your password with others.
Did you watch Inventing Anna?
I have not seen Inventing Anna
Did you
yet.
dabble in that? What
No,
about
I'm still on the Twitter swindler.
What about F1?
Tinder swindler.
I watched that too.
Yeah.
I watched that. What did you make of that?
I walked away with a little bit of sympathy for the guy. Is that bad?
How on earth did you have sympathy for that man? Romain Bostic, how?
Well,
I'm going to plead the fifth on that, John.
Explain yourself. If you watched that, Lisa, how can you have sympathy for that dude?
Honestly, I just think you're the sympathy police today.
Yeah. Well,
You've got sympathy for him too?
No, I haven't watched it. I'm just still going back to the Fed and, this sort of circumstance.
Okay, Romain, I think you're going to get some angry emails when you get back to your desk.
We can talk off camera, John.
Thank you, sir. I look forward to the explanation in my inbox in just a moment. Formula One Drive to Survive. I've enjoyed that. Katie, you watched that?
I have not. I have watched Inventing Anna, though.
F1 season begins this weekend. I know a lot of people excited about that too, just not the people sitting near me at the moment. Lawrence Boone joins us now, Director and Chief Economist. He likes MotoGP, Kaylee, as you know, from the OECD. Lawrence, great to catch up. We got two shocks. We saw it in the ECB's forecast. We saw it in the Fed's as well. They've had to raise their inflation outlook. They've had to drop their projections for growth. It's a difficult position for policymakers, fiscal policymakers to be in. Lawrence, what's your recommendation for how fiscal policymakers should react to the higher energy bills across Europe?
Well, actually, as you're saying, this is a moment for fiscal policymakers. What we are seeing now is a hit to consumers of energy and also of food, and that needs to be addressed with fiscal measures. We recommended means targeted temporary measure to actually soothe the bill for the poorest household, the lower income and lower middle income class people. That will also actually help inflation to be kept in check by lowering the wage price spiral that would come out of inflation bursting without any fiscal support.
So right now, Laurence, I was looking at your projection, and there was a careful categorization of the market response slowing growth materially and pushing up consumer prices. Markets seem to be starting to move on and assume that there's going to be some quick resolution to this conflict, at least relatively speaking. Does that mean that the ramifications economically, however horrific the humanitarian aspect of this is, would be really dampened because the markets have moved on?
So I think we should refrain from any hasty conclusion. The situation is very volatile. It evolves by the day, and we are seeing this not only with the humanitarian situation, which continue to be a flow of refugees, but also in prices, right? So market job is to anticipate what's going to happen in the future. And as the situation evolves, this expectation will move. So I think one known thing is that we will get a lot more volatility ahead of us as the situation evolves. And the unknown is in which direction and how far that can go.
Do you think, Laurence, that the economy can handle in the United States the idea of a hawkish Fed, of more tightening in the face of the inflationary impulse?
So we are not starting in a vacuum, right? Prior to the conflict, And the United States economy was doing super well, very strong recovery, very low unemployment rate, and quite broad-based and high inflation. So in that circumstances, it's actually the Fed, is moving in the direction that it should. Now, these very high energy and food prices mean that some consumers, some households will be hurt. And those households, they need to be supported because for some of them, the energy and food bill is 30 to 50% of their purchasing basket. And if there is this fiscal targeted support measure for these people, then perhaps fiscal consolidation in the US will be delayed a little, but that will also allow the monetary policy to run its course and do its job.
Speaking of monetary policy, specifically for the Federal Reserve, what was absent from its statement yesterday was a mention of COVID-19. It was only actually mentioned in the context of the inflationary impulse because of the supply side challenges the pandemic presented. Has the world moved on from the pandemic as an economic risk going forward?
So I think the pandemic remains an economic risk. You can see that from China with the zero COVID policies, where some cities are being shut down. And many of these cities are manufacturers. They're manufacturing, they contribute to the global supply chain. There's also some technological products. So I don't think we can disregard this risk, right? The pandemic is still with us and in many countries, and this still has impact on supply chain and on the tension, the inflationary tension as well.
European consumers are going to be in such a tough spot through the next few months. Lawrence, thank you. Lawrence Boone there of the OECD. In fact, consumers around much of the world as well. Citi just published, Andrew Hollenhorst and the team. Here's the note. Investors should heed this warning and expect the Fed to continue to raise rates and engage in balance sheet reductions until some combination of higher real rates and lower risk asset valuations are achieved. Lisa, they expect a 50 basis point move in May. They'd previously published that, and they expect the announcement of balance sheet reduction as well. So the next meeting, twin tightening announced, 50 basis point hike, balance sheet reduction, and that line, they'll keep doing this until some combination of higher real rates and lower risk asset valuations are achieved.
So, which brings me to a question that you were asking before. What would you think if you were Fed Chair Powell and you looked at your Bloomberg terminal after his press conference and saw the green on the screen, saw that incredible rally? Would he be happy, or would he actually be upset that he didn't give the kind of hawkish rhetoric that could actually stymie some of the risk rally? Honestly, if the implication is we have not yet seen the bulk of the pain in markets that are required to reach that tightening, then 50 basis points conceivably could be on the table.
So I would imagine off the back of that, neither upset or happy, surprised perhaps. I said surprised. I think going forward, the goal is clear. It's to have tighter financial conditions. There's a range of inputs into that, but he basically said that in the news conference yesterday. That's going to happen as they raise interest rates.
That's going to happen. I do wonder how much, though, he's trying to stymie credit markets, right? We actually saw credit markets rally after that. What is the tightening mechanism if you do have resilience in some of the main metrics of risk assets?
Spreads over the last year or so, Kaylee, year to date, they are wider.
Yeah, wider. Credit having its worst start to a year since, 2008, I believe, John. But you are starting to see financial conditions tightening already to levels that we haven't seen since 2018. And we all know what was going on then, although that was a very different cycle for this Federal Reserve.
Replace March with May, and we're having the 50 basis point conversation all over again. Citi sticking with May at 50 basis points. You wonder if anyone else joins in. Coming up shortly, Michael Herson, the practice head for China and Northeast Asia at Eurasia. That's coming up shortly in 20 minutes' time, a Bank of England rate decision.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. The expanded arsenal that the US is sending to Ukraine includes 100 armed drones. Bloomberg's learned that the drones are tube launched from the ground and plunge into their targets. It's called the Switchblade and it's made by AeroVironment. President Biden has also promised thousands of anti-aircraft and anti-tank missiles. And Russia's finance ministry says it has paid $117 million in interest on its dollar bonds to a correspondent bank. But so far, bondholders in Europe have received no sign of the funds. The payment has come to exemplify how Russia plans to handle its future relations with creditors. The country has 30 days to pay or risk a default. And the price of oil rebounding today following a three-day rout. New York futures were up more than 4% after having fallen more than 23%. Investors continue to weigh the fallout from the war in Ukraine against lockdowns in China. And authorities in Japan says that an earthquake killed at least 4 people and injured dozens more. The quake was a magnitude 7.4. It struck near Fukushima, roughly the same area that was devastated by an earthquake and tsunami 11 years ago. And Robinhood Markets plans to let users loan out their stocks to other financial institutions. It's part of a push to compete with more conventional brokerages such as Fidelity and E-Trade. Robinhood is best known for its commission-free stock and cryptocurrency trading, but it is gradually becoming more of a full-serviced platform. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
If you do any kind of business in this country, there's a pretty good chance that you're going to see that business registered in Delaware. Why? Because that's where you do it. And our point was Wyoming can be that venue for blockchain enterprise, for crypto.
It's not the Wyoming way to sit around and wait for change. We want that independence, we want that freedom, we want that individuality. And that's a common theme that brings together bipartisan support for this in Wyoming.
We want to make sure that people understand, especially in Wyoming, but as the United States as a whole, this trend is coming. It's not going to stop. This is more of a small town that's growing into what I would call the cryptocurrency version of Silicon Valley.
It's the philosophy of that rugged individualism, the independence, and the ability to really get things done for yourself and control your own destiny. You get that from a blockchain, and you don't get that without it.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
President Biden, you are the leader of the nation, of your great nation. I wish you to be the leader of the world. Being the leader of the world means to be the leader of peace.
A deeply emotional address by Ukraine's leader to Congress yesterday. That was President Zelensky. From New York City this morning, good morning. Futures negative 0.4%. We pulled back. Crude climbs back through 100 and about 60 cents. Up by 5.8%. $100 crude all over again. Some comments from Dmitry Peskov, the Kremlin spokesperson, earlier today. The Financial Times had a report out yesterday that the two sides, Ukraine and Russia, had made major progress towards a deal. These were the words of Peskov, the precise words. Here's the quote. On the whole, that's wrong. Some correct elements, Lisa. His words. But on the whole, that's wrong.
Basically, we're not nearly as close as the implication is. However, there are talks ongoing. That's how I interpret that. Although, again, who has the credibility in the Kremlin? One person. Do any of the spokespeople around him actually bear the weight to be able to make any kind of sense in this progress? And frankly, do we trust it?
We're watching the words, and we keep going through the following exercise. It's an important one, Lisa. You take the words, you look at the action. Contrast the words and look at the action. The action on the ground, it's hardly getting better, is it?
The idea of bombing areas where you know people are becoming refugees, basically in the basement trying to hide out, does not suggest a close end to this conflict.
Michael Hurston joins us now, Eurasia Group China and Northeast Asia practice head. Just on words versus action, can we just touch on this because it had such a major impact on equity markets yesterday, Michael? Government departments in China should, quote, actively introduce policies that benefit markets. That's according to a meeting of China's top financial policy committee, led by the Vice Premier Liu He. Michael, what did you make of that? That's the words. What kind of action, follow-through, do you expect?
I thought on the whole it was a constructive statement. The reason I think it was constructive is that it went piece by piece to address some of the key concerns for markets, whether that's the potential delisting of Chinese stocks, whether it's regulatory actions that come not from the securities regulators, but from other agencies that have roiled the markets, and even a nod to the property sector. So on the whole, I think that's the right approach, is directly address market concerns. The problem is that Vice Premier Liu He is very influential, but many of the issues that are weighing on markets are outside of his direct purview. It includes the worsening COVID outbreaks, the spillovers from the Ukraine crisis, including China's stance, which is going to be a foreign policy decision that rests with President Xi, and some of these other issues that are hanging evidence for the rest of this year.
Idea of this Ukrainian that actually will have provoke sanctions.
The risk is walking for Russia or certain types of economic and financial support that cross a line. It does place China at risk of sanctions, of tighter export controls, and of just a broader worsening of the relationship. So that is absolutely the risk. I don't know if that's fully registered with the Chinese side, but that is, I think, a very important issue to watch. And really the next step here, or the next signpost, will be whether or not President Xi and President Biden have a conversation in coming days, because that is going to be very important to avoiding this kind of miscalculation.
Well, Michael, how much do you think President Xi would be willing to risk in order to maintain a friendship with Russia? How strategically critical is Russia to China?
It's a difficult balance. I think what we need to differentiate is China's support for Russia broadly, which I think is not going to change, and then the more concrete, specific role that China plays in terms of trying to de-escalate this conflict. It's not an easy balance to walk, but what U.S. officials really are going to be focusing on is China using its influence to try to de-escalate. That could still happen with China being somewhat close to Russia. I think the problem is that Beijing has made a political signal Xi has made a political signal that he supports Putin. I don't think that was intended to give a full green light to the invasion, but that's what China's system and leadership is trying to navigate now. How do they distance themselves? To what extent do they want to distance themselves? But I think its support for Russia is clearly becoming more of a strategic liability at this point than a strategic asset for China.
Well, Michael, that final point I think is important. To what extent do they want to distance themselves? And how interested are they in just having this conflict continue?
I don't think China has an interest in seeing the conflict continue. This is a year that was supposed to be about stability for China. This is worsening multiple aspects of the stability drive with the 20th Party Congress this fall looming in the backdrop. I think Beijing views Russia as an effective counterweight to a more hostile U.S. And to a Europe that's increasingly aligned with the U.S. But now that Putin has started this adventure in Ukraine, it is deeply worrying to the Chinese side. We don't know yet where they're going to come down on this, but I think what we're likely to see is China looking to provide some degree of economic support to Putin and diplomatic support, not to become directly involved in the conflict, and for the most part, to comply with U.S. sanctions and export controls. But if I'm wrong, and if China leans too far to the Russian side, I think it definitely has serious risks for the relationship and for sanctions and export controls and a range of other measures.
Oh, particularly for sanctions, this could get messy, and messy quick. Michael, thank you so much for your time this morning. Thank you, sir. Michael Herson there of Eurasia Group. This market turning a bit lower, off by 1/3 on the S&P. Crude turning a lot higher. We're through 100 on WTI. Lisa, we're up more than 6%.
The volatility in crude, I really feel like we got to sit on that because, yes, you're seeing that knee-jerk move up because of the potential for this conflict to be prolonged. But to see things whip around so much in a market that dictates how much people pay, not only for their gas and oil, but also, frankly, for products that rely on the transport of goods, just makes me wonder, again, about the consequences of the financialization of this market.
Vladimir Putin out with a headline just now, Kaylee. How are we going to clean this up? Vladimir Putin, the Russian president, saying large Russian business banks may work in Crimea too.
Well, and Crimea is going to be a critical question, John. When we talk about any kind of progress in talks, those territorial disputes are also going to be front and centered. When the Kremlin comes out and says little progress is being made, we can't forget Crimea, we can't forget the Donbass. When Ukraine has previously said it's not going to cede a single inch of its territory, these are all remaining questions, let alone the issue of neutrality or security guarantees for Ukraine.
Live pictures of the Russian president holding a meeting with top officials of Russia and Crimea on the development of the peninsula ahead of the 8th anniversary of the annexation on the 18th of March all those years ago. Futures down 1/3 on the S&P. Your Bank of England decision coming up next. Reaction with Sarah Hewen of Standard Chartered. This is Bloomberg.
almost the end of the year, but Bali is still quiet and empty. I am here in Kuta Legian, one of the main walking streets here that is used to be a tourist spot for beach, dining, shopping, but many shops here are still closed. Most of the outlets are either for rent or for sale as they have run out of business.
Saya kerjanya di sini udah lama, udah ada 10 tahunan di sini kerja. Masih sepi sih, nggak kayak dulu. Kalau dulu kan rame, sekarang ya ada 1-2 itu ada. Tapi Nggak kayak dulu, kalau dulu ramai sekali. Sekarang paling dapat jualan ya 100, 120 gitu. 200 ya. Kalau dulu sih ya nyampe dah 1 juta, 1,5 tuh nyampe dapat jualan. Bisa sampai 2 juta dulu. Sekarang nggak pernah lagi dapat segitu. Sama aja. Belum ada turis ke Bali. Masih ya domestik aja.
While Bali has reopened its borders for foreign tourists since October, they're still not coming in. Many international airlines are yet to reinstate their direct flight to the island. Balinese people here really hope they can see more people from Australia, China, and Europe to come visit next year.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Stocked early enough all these precious materials you were just mentioning, and we were on the lucky side that our prognosis was spot on in a way, forecasting what kind of material we would need and what quantity we would need.
Wherever you get your news.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
When we ask consumers what are they worried about, they're saying, look, inflation is just a big issue for us.
Look at the cost of shelter, the cost of housing. That's gone through the roof.
U.S. consumer has lost some momentum in terms of sentiment.
We're in an environment where growth is being cut in the future.
Nobody has an advantage because nobody has seen this type of market environment.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Live from New York City, we got another one. Good morning, good morning. This is Bloomberg Surveillance on TV and radio alongside Lisa Abramowitz and Kenny Lyons. I'm Jonathan Farrow. Futures down 1/3% on the S&P 500. Here's the move from the Bank of England. 75 basis points up from 50. Cable rolling over. 130 maker saying $155 on sterling. Bloomberg's Guy Johnson out of London.
In terms of the message that was being communicated. That is not what Mr. Cunliffe is doing. He's decided that he is going to back no change. There was maybe some expectation that that vote count would go the other way. It's not happening. So the 2-year yield has come down very sharply. As you say, the pound reacting negatively to it as well. But then you get to the inflation question, John, which I think is really fascinating. Around 8% in the second quarter, may climb higher later. That would seem to imply that maybe actually rates need to go higher further down the road to deal with that. The real question we don't know the answer to yet, and I think the Bank of England's job is maybe even harder than the Fed's job because the growth hit could be greater. What does that growth hit look like in the second half of the year? We don't know the answer to that question. You talk to economists right now, they're using their gut at the moment. I'm not sure how useful economic models really are in terms of determining the path here. The Bank of England, though, has to make a decision. We're now at 75 basis points. The other factor to remember here, John, is that when we get to 1%, we are getting into the trigger territory for the bank to start quantitative tightening as well. That's another factor that we need to consider in terms of this. But certainly, judging by the 2-year reaction at the moment, yields down, pound down, the market is taking this as being more dovish than anticipated.
They're not really conveying with conviction, Guy, what they'll do next, unlike the last few meetings where they did basically imply the next move is a rate hike. Let's think about where sterling's gone, Guy. We've gone from 50 basis points to 75 on the Bank of England rate, and sterling has come lower again at 130, 133. At the last meeting, 135.98, just short of 136 following a rate hike. They've hiked rates again and we're weaker. Guy, what do you make of that? Just the trajectory. We start a rate hiking cycle, sterling's not getting stronger, it's getting weaker.
Well, it's a relative trade, isn't it, John? The dollar is the factor here that you need to think about. This is, I would say, probably more of a dollar position story than a pound position story. And that, I think, is probably the sort of perspective you want to look at that trade from. It is a pair. But I think the fact that the pound is down is problematic in some ways because commodities are priced in dollars. It's the same conundrum that the ECB faces in some ways. Now, a significant price move higher in the pound isn't going to be probably great enough to significantly affect the terms of trade, but it is a factor in terms of the thinking. But I think probably I would look at that from a dollar point of view. But traders certainly, and this is the latest headline, traders are raising a bet on a single half-point BOE rate hike by June. The market is pushing down the rate expectation story for the Bank of England. But with the inflation outlook they're talking about, John, that just makes me once again scratch my head. Like so many other things at the moment, I think this market is really confused as to the trajectory. I think here in Europe, the problem is much greater for central banks because in the States, the Fed is pointing to strong growth. In Europe, in the UK, that growth question, I think, is much greater, and I think the possible outcomes and the spread in those outcomes is much greater as well. The hit is going to be greater from the Ukraine war. The hit on the energy crisis is going to be much greater. The hit into Germany and then onto the rest of Europe is going to be much greater. That's what we don't know yet. We don't know what that's going to look like in the second half of the year.
Guy, I'm with you. I'm looking forward to the coverage in a few hours' time on A Close with Guy Johnson. Lisa, make sense of this. CPI could climb to around 8% in the second quarter, inflation in the UK to be precise. May climb higher later, and we're talking about whether they will or won't hike. Perhaps, again after this one?
Right, so this perhaps is the clue to that. There was some discussion, a lot of discussion rather, on the slide in real incomes. We talk about the real wages being negative, and they discussed that extensively. They also talked about renewed supply chain problems due to the Ukrainian war. So they might see inflation go up for all the wrong reasons and then come back down pretty violently later on. And perhaps it'll take longer for that to happen, but they still have faith in that whole trajectory. It is a different message. It is a similar impulse that they're trying to deal with, that the Fed has been dealing with, but it is the opposite kind of approach, to not do too much because this is a stagflationary shock.
A 25 basis point move from the Bank of England, sterling negative, a couple of tenths of 1% now, cable down at 131.25. As these headlines came out, we had an interview with Klaus Knott, a headline from the ECB's Klaus Knott, does not rule out 2 interest rate hikes this year at the ECB. That would certainly go against the grain. And then an additional headline dropped. The President of the United States will be speaking to Xi Jinping this Friday about Russia. So let's sit on that, Lisa. We just had a conversation with Eurasia Group about this link, this relationship between China and Russia. Now the United States holding a call this Friday.
To me, this feels crucial because a lot of people have been saying, frankly, China holds the keys to the resolution of this conflict. They could alone pressure Russia in a way. And the idea that how much are they concerned about the ramifications from the United States? Are they somewhat conciliatory in that discussion? Could be somewhat telling in terms of how long this conflict could last.
Where to start this morning? Let's get to Sarah Hewen, the head of Europe and America's research at Standard Chartered. Sarah, can we start with the Bank of England, work our way through the ECB and get to the Federal Reserve eventually? Can you see inflation at around 8% in the second quarter and the Bank of England not being more active through this rate hiking cycle through this year?
Well, it looks as if they are losing their nerve. And of course, since the last meeting, we've had a massive change in circumstances, which really risks the stagflation in the UK. We have rising inflation. Inflation 8% looks like it could even go to double digits later this year. And although the data that we've had so far for the UK economy have been pretty positive for January and February, there is a clear concern about the squeeze in living standards that is to come. We are seeing inflation essentially at double the pace of wage increases, and that's not good news for the economy. I think also the comments on the supply side constraints suggest that there's more consciousness that these costs coming through are externally generated, and that they potentially pose more of a risk for growth over the medium term. So it's possible. I mean, we're expecting another rate hike in May, but we think that will be it. We think by that stage there will be a clear sign of slowdown in the economy, and that the Bank of England will need to pause.
Sarah, is there a message in this for the Federal Reserve that basically if the inflation is coming from something other than monetary policy, raising rates, isn't necessarily the answer? Or is the Fed just dealing with a completely different set of issues that also is a bit more driven by monetary policy?
I think there are differences. The UK economy is more exposed to the EU economy, and that in turn is more exposed to the downside risks from the Russia-Ukraine war. So we're likely to see further downgrades to EU growth and potentially to UK growth. Whereas for the US, they are insulated to an extent. Similarly, from an energy point of view, obviously, the gasoline price is rising, and that's a negative for US consumers. But it's less of a case than it is in Europe. I mean, we are still quite nervous about the US outlook. We would only, we're expecting another 3 rate hikes this year from the Fed, but we think that those rate hikes will be front-loaded, and that when we get to the summertime, that there will be clear signs of a slowdown. So I think it's the same phenomenon that's facing not just the UK, not just the EU, but also the US, and it just may be a matter of that impact being more delayed in the US.
Sarah Hewen of Standard Chartered. I think it's fair to say, based on the reaction at the moment at least, that this has been interpreted as a dovish hike. This line here, Katie, that you picked up on in a statement that was released from the Bank of England, the committee judged that some further modest tightening in monetary policy might be appropriate in the coming months, but there were risks on both sides of that judgment.
Yeah, the language change is really important here. The change from likely, which was February, that hikes would be necessary, to might be, maybe throwing some cold water on the idea that this bank is going to have to move aggressively. And I wonder if this is a BOE that is more worried about the potential growth implications of this conflict, what this will mean on the fiscal side when Rishi Sunak takes the podium next week, and how that balance is shaking out in the UK, maybe differently than how the Federal Reserve or even the ECB, with not viewing 2 hikes potentially this year, are viewing it.
See, Bramo, I can see how you might interpret that, everything Katie just said, as a dovish hike at the Bank of England. Can you do the same thing for the Federal Reserve and the language of the Fed chair yesterday in that news conference?
So there were a number of people who did come out, and they said that this is dovish. I didn't hear a dovish chair. I personally didn't. I don't understand where that comes from. Some people attributing the move that we saw in risk assets to a more dovish intonation, but he was pretty adamant that there was such strength in the labor market to almost be dangerous, and that they really needed to tighten much more aggressively than they had realized a couple months ago even.
He said this labor market, this economy could flourish in the face of tighter financial conditions. Flourish, withstand higher interest rates, and then the amount of pushback we've had. I mean, I just put out the statements, Lisa. I just throw out the quotes, and I just get replies like, yeah, no chance.
Yeah, I mean, frankly, that is the collective message from the bond market. We don't buy it.
Futures down 0.25%, yields in 5 basis points on treasuries, and a 2-year in the UK. Yields lower, sterling weaker off the back of an interest rate hike. Are we calling this one a dovish hike? I think many people are. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. The Kremlin says the reports of major progress in peace talks with Ukraine are wrong. That comes a day after Russia said a proposal for Ukraine to become a neutral country with its own armed forces could be seen as a compromise today, as Kremlin spokesman said the Ukrainian negotiators are in no rush. The House is preparing to revoke Russia's free trade status with the U.S. That would enable the U.S. to impose higher tariffs on Russian goods. If the House action becomes law, Russia would be put in the same category as countries such as North Korea and Cuba. China is appearing to distance itself from the Russian invasion. The foreign ministry has endorsed remarks by China's ambassador to Ukraine, who said that China would, quote, never attack. It's unclear whether that pledge could be read as a guarantee that China wouldn't provide military aid to Russia. And the price of oil rebounds today following a three-day rout. New York futures were up more than 4% after having fallen more than 23%. Investors continue to weigh the fallout from the war in Ukraine against those lockdowns in China. And more chaos in the London nickel market. Brokers trying to sell at the 8% daily price limit had their orders cancelled. That prompted the London Metal Exchange to delay the opening of electronic trading. It's a further setback to the LME's attempts to restore some order following a week-long suspension. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Is this going to primarily be chips for your own business, or is this going to be more centered around the foundry business and external customers?
It's going to be both. And what we said today is we're announcing 2 fab modules. It's a large location, 1,000 acres, because I'd hope to build out a full 8 fabs or more on this location. And, you know, if we do that full project, it would be $100 billion over the course of the decade or so. So a massive project, initially 3,000 jobs, 7,000 construction workers, supply chain, et cetera. I mean, this is just fabulous. And the products will be our most leading edge chips. So as we said, this will be the angstrom era when we're going to 2 nanometers and below into the angstrom era. So it'll be the most advanced chips, potentially the largest manufacturing location in the world. We'll use its output for our internal products, but also for those of the foundry customers as well. So it's going to cover both.
Lots happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
But we need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Happening on Bloomberg in March. First, Bloomberg Triple Take, breaking down the day's biggest stories.
Today's Triple Take focused on the energy transition.
Then, the return of Bloomberg ETF IQ.
The last major holdouts of the ETF revolution.
And the debut of Bloomberg Crypto.
The CEO of Binance weighed in.
Finally, David Rubenstein brings you insights and advice from the world's greatest investors on a new season of Bloomberg Wealth. All this March, right here on Bloomberg.
Allies are united, both in providing support to Ukraine, but allies are also united when it comes to that NATO should not deploy forces on the ground or in the airspace over Ukraine.
Jens Stoltenberg, the Secretary General of NATO this morning. Good morning to you all. Futures negative 1/3% on the S&P. On the Nasdaq, we're negative about 1/3% also. Crude's flying up by almost 6% to $100 and about 60 cents. The latest line out of the Kremlin this morning, Lisa, Russia, pointing to that FT report saying the following. It included some correct elements, but on the whole, it's wrong.
Basically, no ceasefire, no resolution anytime soon. And we've been talking all morning about trying to cohere these comments about possible resolution with what we're seeing on the ground in those images, which are in stark contrast to that kind of tone.
We've spent a lot of time talking about energy security, as you might expect. One thing we tried to do on this program over the last few weeks is bring it back to food security as well. We heard from the Agriculture Minister of Ukraine this morning. Ukraine said the following: the situation with Ukraine's food is, quote, under control. They went through the stockpiles, things like wheat, things like corn, said wheat stockpiles were sufficient for 2 years, corn stockpiles sufficient for 1.5 years. Let's talk about food security, domestic and international. And really, one of the best guests I can think of for insight into the inner workings of the Ukrainian economy, the former Ukraine Finance Minister, Natalie Jaresko. Natalie, fantastic to catch up with you again. You are perfectly positioned to run us through this. Help us understand the threat to both domestic food insecurity and international food insecurity as well.
Well, thank you very much for having me. I think on the domestic side, what they said about the stocks is very true, and I don't think it's the issue of whether or not there's sufficient stocks. I think the challenge is right now food security, in particular in the cities that are being besieged, because there's no way to get food into the cities, and those that are still functional, Kiev, for example, the capital, are having trouble getting bakeries to function. And so the challenge is taking those stocks and translating that into food, I think usable food for the population. With regard to the international community, that's very different. Everything depends on whether or not farmers are able and willing to go out and farm and to plant this spring. And as you've seen, Ukrainian farmers have a lot of other things on their minds, including taking some of the tanks. So it's a question of how much of the arable land is going to be safe without bombs flying overhead to plant. And if not, I think you're going to see a serious food problem globally, in particular in Northern Africa and the Middle East.
Meanwhile, Natalie, earlier this morning we were speaking with our own Maria Tadeo, who said that in 2 weeks, Russia single-handedly destroyed Ukraine's economy. And I wonder how lasting that destruction will be, which speaks directly to the food security. How soon after the conflict ends could those farmers get back out? Could the land be salvageable?
Well, if we miss this planting season, we're not talking about planting again until we have a minimal winter season, and then it's next spring. So really the time is the next two months for planting. And if we miss this season, then I think you're going to see global food prices rise substantially.
That's the damage to the Ukrainian economy. When it comes to the Russian economy, we know already a lot of damage has been done by sanctions already put into place. From your perspective, Natalie, how much powder is still in the keg? How far away is the West from having exhausted all of its options on that front?
We're very far from having exhausted our options. We've been pretty timid. There have been a couple key sanctions that have had an effect, meaning the freezing of the reserves of the Central Bank of Russia, which has affected their ability to support the exchange rate, and then the devaluation of the ruble has caused bank runs and so on. But I think we're not yet seeing the rest of the banking system frozen, so we do not have full blocking sanctions, even against Sberbank and VTB, the two largest in the system. Those only have minimal sanctions. And then the rest of the state-owned banks are still unsanctioned. State-owned energy companies, unsanctioned. We still haven't sanctioned the state-owned logistics companies, the state-owned transportation companies. I think there's still quite a bit to do. We've done, in the United States, a ban on oil imports, but that really is the limit of it. That and some increased tariffs in Canada. We really need everyone in Europe to join in at a minimum, increase in tariffs on Russian imports, if not a ban on certain, in particular, oil and gas. So there is still a wide variety of sanctions that haven't been used. And frankly speaking, I think we've been too timid. We need to move much more quickly.
And that seems to be the message from Vladimir Zelensky this morning. In Germany, he was saying, you guys need to stop with some of these gas payments, although it does become very difficult because they rely on those pipelines for their lifelines and for costs to remain within control. What are you looking for in the next couple of days, the next couple of weeks, to try to bring this to a close?
First and foremost, it's delivery, urgent delivery of those military supplies, some of which were promised by President Biden yesterday, in particular air defense. It is the bombing and the missiles that is causing the most tremendous amount of death. What you saw with the bombing of a theater in Mariupol in the southeastern part of the country, with 300 to 500 civilians inside. That can't be stopped, but by the very brave Ukrainian armed forces on the ground. We need the air defense. So number one is increase the military support urgently to Ukraine so they can defend themselves. Number two, I would ask for blocking sanctions on the state-owned banks. Blocking sanctions, meaning no more doing business with Russian state-owned banks. If a few existing contracts need to be carved out in Europe because of the energy contracts, then find a way to permit by license an individual contract, but stop and cease doing business with Russia.
Natalie, can I say thank you? We had important conversations 8 years ago, and unfortunately, we're having those conversations again. Thank you very much for being with us. Natalie Jaresko, the former Ukraine finance minister. A few things have happened this morning, particularly in the last 30 minutes, so let me get you up to speed. We have got a report, an understanding that Putin has spoken to his spokesman at the Kremlin, and the Kremlin, Lisa, has turned around and said the following on that FT report. Some correct elements, but on the whole, that's wrong. No big major breakthrough in talks between Russia and, of course, Ukraine. On the United States and this relationship between Russia and China, President Biden will speak with Xi Jinping this Friday about Russia. That, Lisa, tomorrow, an important conversation.
Possibly the most important conversation diplomatically this week, considering that China has remained pretty quiet, has not necessarily weighed in other than to say that they'd like to see some sort of resolution. How much do they double down on their backing of Russia, or do they start to back away and give some idea that perhaps the support isn't that strong?
And then the compare and contrast between the central banks, the Fed yesterday and the Bank of England 25 minutes ago. Kelly, they raise interest rates, 25 basis points. The vote is 8-1. It's called a dovish hike because they didn't exactly convey with conviction the next meeting would contain an interest rate hike.
Yeah, they said it might be necessary to raise rates further, not that it's likely. The Bank of England seems to be prioritizing growth over inflation. For the Federal Reserve, the message yesterday was inflation comes first.
One thing we've barely talked about, the domestic data in America. We've had retail sales early this week. We've got jobless claims up next. Mike McKee's in the seat, ready to break it down. From New York, this is Bloomberg.
estudio, nuestro experimento, no hemos pintado todos los edificios de blanco, sino estos más asequibles de pintar. Y ya hemos detectado reducciones medias en el área metropolitana de 0,8 grados aproximadamente en un periodo de ola de calor y con picos máximos de 4 grados de disminución en un momento puntual del día, en una zona puntual del día. Y como dices, en una ciudad como Barcelona funciona incluso mejor que las zonas verdes, según las modificaciones nos detectan incrementos, o sea, disminuciones de temperaturas mayores con tejados blancos que con incrementos de zonas verdes como tienen planteados el plan director urbanístico.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
From New York City.
We're in London, in Sydney, in San Francisco.
9 a.m. in Beijing and Shanghai. Good morning, everyone.
Have a great evening.
So recap the headlines.
You do not want to miss this
How
story.
are you thinking about those dynamics?
We are seconds away from some economic data in the United States of America, live on TV and radio, with futures down 0.4% on the S&P, on the Nasdaq down about 0.5%, with your initial jobless claims data and a whole lot more. Let's get to Mike McKee. Morning, Mike.
Good morning, John. Well, let's start with jobless claims since you mentioned it. They dropped down to 214,000 last week. The initial print was 227, so continued improvement there. And then we can probably add to that, nobody really cares because we're kind of back to normal with jobless claims. But housing starts do matter because house prices have been contributing to inflation, and we know where that goes if you're drawing a line to the Fed. Housing starts at for the month of February up 6.8%. which is a significant improvement over the drop of 4.1% the month before. The building permits, though, come in down 1.9%. Now, all of this is very volatile. The numbers change every month. A lot depends on the weather. But if building permits were to reflect a change in builder sentiment, and we did see it drop this week, then that might be something that would affect the economy down the road. So something to keep an eye on. And then the Philadelphia Fed comes in at 27.4, last month 16. So strength in manufacturing in the Philadelphia district probably gives some view that things are still strong, and maybe supports a little bit of what Jay Powell was saying to us yesterday about the economy able to withstand rate increases.
He kept saying it, didn't he? Quote, all signs are that this is a strong economy. We do feel the economy is very strong, well positioned to withstand tighter monetary policy. Mike, no big moves off the back of this. I'd say the two-year yield gives up some of the morning gains, back to about 193 or so. Mike McKee, the conversation we've had all morning, and when you speak to your friends in the economics profession, I wonder what they're all saying to you now. There is disbelief that the Federal Reserve can achieve tighter financial conditions, higher interest rates, 2.8% by year-end next year on the Fed funds rate, without damaging the labor market, without unemployment climbing. Mike, what say you?
I agree with that sentiment. We'll talk about it more on the Open coming up in just a few moments here on Bloomberg TV. But basically, I think the clue to what's going on is the dispersion of the dots as you get farther out. The Fed, some people characterize it as the Fed admitting they don't know what's going on. And while that sounds like you're criticizing them, I don't think they know what's going on. They don't know what's going to be happening in the economy down the road because we don't know if COVID's going to come back. There are reports of that. We don't know what's going to happen with the war. Just so many things in play at this moment that probably the only thing you can count on is a rate increase at the May meeting.
Mike McKee, thank you. How big will that rate increase be, though? 25, 50? Going to do that all over again with Jay Bryson, Chief Economist at Wells Fargo. Jay can hardly wait. Jay, let's start here with a question we've asked all morning. Can you raise interest rates without unemployment climbing? Sure you can. We've seen that happen before. Can you move to a restrictive stance, tighten financial conditions, and do all of this, reduce the balance sheet over 18 months and get yourself back to somewhere close to 3% without unemployment rising? Jay, that's a big task, isn't it?
You know, John, it is a big task. I mean, the Fed is in a very tricky sort of position right now. But, you know, if you go back to the 90s, and I know that sounds like ancient history to some folks, but, you know, between 1994 and 1995, the Fed did raise rates by like 300 basis points. And, you know, they were throwing in 50 basis point rate hikes, they were throwing in 75 basis point rate hikes. There was concern about inflation at the time. The economy, it hit a little bit of a rough patch early in 1995, but they were able to pull it off. Now, I'm not being a Pollyanna. I'm not saying they're necessarily going to pull it off again this time, but it has happened before.
So, Jay, are you saying that the bond market is perhaps a little bit too gloomy, and I can't believe that I'm saying this, but a little bit too gloomy with the flattening in the yield curve, and as people realize that the economy is perhaps in certain sectors, particularly in the consumer area, less sensitive to rate hikes, that it can withstand vastly more than they're expecting?
Well, so if you look at the 2-10s, you know, the spread between the 2-year note and the 10-year note right now, it's about 20 basis points or so. You know, as long as that doesn't invert significantly, I'm not really all that worried about it. And again, if you go back to previous tightening cycles, you get to a very, very flat yield curve at times. So it's certainly something that we're keeping an eye on. And more generally, you look at financial conditions right now. If you look at corporate bond spreads over treasuries, and, you know, the stock market has come off. So in general, we have had a financial tightening that's going on. And with the Fed raising rates here, it's, you know, as I said, you know, when we first started here, it's going to be tricky for the Fed to pull this one off.
Jay, do you agree with economists who think that because there has not been even more of a reaction in risk assets, the Fed will be even more aggressive in May with the beginning of their balance sheet shrinkage, as well as potentially even a 50 basis point rate hike?
You know, Lisa, I don't know if it's all up to just, you know, risk assets in general. I think it's lots going to depend upon the Fed is in data dependency mode right now, right? And the world can change between here and May. And so, you know, we'll see what happens. I mean, our view is that the Fed will announce balance sheet reduction starting in June. Who knows? Maybe it gets pulled up to May here. But it's coming, assuming that the economy doesn't get completely derailed here. I think they'll start it out slow in terms of the balance sheet reduction, and then it'll kind of pick up, much like it did the last time around as well.
Well, Jay, when you talk about data dependency for the Fed, Chairman Powell seemed to indicate yesterday that getting inflation under control, price stability is a prerequisite for everything else in their mandate. So when we talk about data dependency, are we essentially exclusively talking about inflation data, about CPI, about PCE?
No, I mean, I think those you know, the inflation data, I think, are the prime things that the Fed is looking at right now, along with inflation expectations, you know, measured both in the bond market and measured by the University of Michigan sentiment survey. But they're also they look at everything that's coming in, and so, you know, maybe labor market data takes a little bit of a backseat right now. But it's not like they're going to completely ignore that. And if we see signs that the economy is really decelerating in the coming months, I think the messaging out of the Fed is, okay, maybe we're going to start to back it off here a little bit.
On that deceleration, Jay, do you anticipate that, especially given the uncertainties around the war in Ukraine, or does that ripple effect not really hit the U.S. as hard as it may Europe?
So I think it hits Europe harder than it does here in the United States. You know, there's more, if you look at the United States, we have very, very little direct exposure to Russia, both financially as well as economically. Europe has much more exposure as well. So, you know, the primary thing that Russia is causing here in the United States is higher oil prices or higher gas prices. And that's something that's leading to a deceleration here. Outside of that, there's very, very few linkages between the U.S. economy and the Russian or Ukrainian economy to lead to a big deceleration, again, outside of gasoline prices.
Jay, just quickly, one rate hike and 2's 10s is already about 20 basis points. We're already seeing some form of inversion, 7-year yields above 10s. We saw that with 5s a little bit earlier on this morning, 3s threatening to do the same. Is the Fed comfortable to push through that? Do you think, Jay, this time around, given where inflation is, given where their focus is this time around?
Well, so if you look at what's priced into the bond market right now? 7 rate hikes. I mean, that's what the dot plot. So 7 rate hikes this year. That's what the dot plot said yesterday. So in theory, if the Fed does 7 rate hikes this year, and that should be all completely priced in. In theory, that shouldn't cause the yield curve to invert. But if the market starts to anticipate even more aggressive tightening or more tightening out in 2023, then that's potentially where you could get your inversion.
Jay, thank you, sir. Jay Bryson of Wells, we appreciate it. Just on crude and crude supply, how the story's changed for Secretary Granholm in the last 6 months or so. Do you remember, Lisa, when we asked the Energy Secretary here in the United States about boosting domestic production? Why couldn't we do something there to get crude prices down? And we're essentially laughed at and told to ask OPEC. This is the line on CNN. And I understand things have changed. Russia's in the mix now in a big way. But the line on CNN, oil companies must be sensitive of the situation and step up. The quote from the Energy Secretary here in America, this is a moment for us as a nation and as industries to step up and do your duty to increase supply.
All right, so this to me shows how much the alliance between the oil industry in the United States and the Biden administration is deeply uncomfortable after a lot of rhetoric basically saying they are the old guard, we need to bring in the new guard. Now there is a real willingness to engage them in a much more material way, and not only engage them, but push them into producing more at a time when there still is so much volatility. Can they respond? Will they respond? I don't know that that's clear yet.
Do you remember COP in Glasgow, end of October, start of November? Do you remember that? The President of the United States was in Europe and was leaning on OPEC to boost production. And then we went and had a committee, a big meeting. Kayleigh talking about pulling back from fossil fuels. At the time then, we all said the contradiction was just screaming off the sheets that these guys were reading off. And here we are.
Yeah, it was really quite remarkable at the time, John. And I would say that the U.S. hasn't abandoned trying to get OPEC to pump more either. That is still in conversation. We saw Boris Johnson also traveling to the Middle East this week with the same goal in mind. But the turn toward shale here, my question is, A, can you get shale to abandon discipline? And then B, why did it take so long? I mean, we talk to shale CEOs here on Bloomberg TV and radio all of the time, and I spoke to multiple who said the administration hasn't called yet, and that was already when this crisis was underway.
A moral obligation to pull back from Russian crude has been a big part of the conversation now for a month. And Lisa, once you start to introduce the moral question, I think the electorate, both here in the United States and in the UK for that matter as well, in the UK, the response was, okay, if we've got a moral obligation to pull back from Russia, why are you flying to Saudi Arabia with a human rights record there too, on a weekend where we saw the number of executions in that country? You can see how awkward this is getting for these politicians. You've got one rule for one country, and seemingly you're allowing to make some kind of allowance for another country with terrible human rights records behind them. China, the Communist Party there, another one in the mix too. Venezuela.
Yeah. But then at home, you're also squeezed because higher oil prices affect the lowest income earners the most. So they actually see their purchasing power and their well-being diminished as well. So it's a very complicated situation on all sides.
The contradiction between a difficult foreign policy with domestic policy ongoing. Futures down 0.4% on the S&P. Coming up, Matt Hornback of Morgan Stanley on this bond market. Less politics, more central banks. 20 minutes away. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. The expanded arsenal that the U.S. is sending to Ukraine includes 100 armed drones. Bloomberg's learned that the drones are tube-launched from the ground and plunge into their targets. It's called a Switchblade and is made by Aerovironment. President Biden has also promised thousands of anti-aircraft and anti-tank missiles. Russia's finance ministry says it has paid $117 million in interest on its dollar bonds to a correspondent bank. But so far, bondholders in Europe have received no signs of the funds. The payment has come to exemplify how Russia plans to handle its future relations with creditors. The country has 30 days to pay out or risk a default. White House coronavirus coordinator Jeffrey Zients plans to leave the Biden administration in April. He'll be replaced by public health expert Ashish Jha of Brown University. Zients spent much of his time securing the purchase and distribution of vaccines, as well as treatments, tests, and protective equipment. The UK will examine why access to business finance appears to be a major barrier for the ethnic minorities. The goal is to make it easier to spot racism or unconscious bias in bank lending. According to a 2020 report, more than a third of ethnic minority entrepreneurs cited access to finance as the reason they stopped working on their business idea. Global News 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
The first step in building a connectome is to get your hands on some brains and then cut them up. It all sounds very grim, but Harvard turns out to be quite efficient with its brain harvesting. Jeff's lab can do a year's worth of research with a single mouse brain. Small chunks of the brain are fed into the slicer, where a diamond blade carves off a thin sliver of tissue. The tissue floats along some liquid and onto a piece of tape. The brain slices are then put into this very large machine, where they're photographed in the finest of detail. Software helps stitch the pictures back together into a single 3D image, and algorithms are applied to help make sense of what's going on inside of the brain.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Energy prices and a short supply of key chemicals that produce synthetic fertilisers are sending pig, cow and horse manure prices soaring. Even human waste is in demand as farmers hunt for alternatives. Fertiliser helps increase crop yields.
You can see how much moisture is held into this. It's a lot of organic material into the compost. So it breaks down, the manure and the straw breaks down into a friable mix that can be mixed into your soil in the ground and for growing a whole range of different vegetables. Holds the nutrients in, holds the water in, and it really increases the kind of biodynamic profile of the soil.
The recent price spike could mean more farmers going organic for the long term.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
owing to the war, Europeans will, in the short term, confront higher inflation and lower economic growth. Accordingly, the challenges facing monetary policy are changing.
That is Christine Lagarde, ECB president, talking about the tricky road ahead for central bankers around the world. Of course, we are now digesting the Fed headlines from yesterday. Was it a hawkish hike? Was it a dovish hike? We are still trying to figure it out. You are seeing a bit of softness in equities right now, and this came on the heels of some comments out of the Kremlin talking about how talks were perhaps not as far along as reported yesterday. You are seeing a bit of a reversal in some of the moves from yesterday with the 10-year yield down, but just slightly down, less than it was earlier this morning, 2.16%. And dollar weakening, this to me, Kaylee, has been so interesting. Typically, when you get a Federal Reserve that is ready to hike, begins a rate hiking cycle with such ambitious projections for where they hope to get 2.8% by the end of next year, you do wonder why you're getting a softening in the dollar, especially given the fact that you're seeing others, namely Bank of England, back away a little bit.
Yeah, maybe that was the dovish hike from the BOE. And it's interesting, if the Fed matched its hawkishness to where the market already was, is the market now turning around and saying, actually, we don't believe you're going to be able to pull that off? And we also have to consider, Lisa, this was a market that had done a lot of work in the run-up to the Fed decision before it even lifted off. The hike now has come, but even before that, financial conditions had already tightened to levels we haven't seen in years. That is the subject of Kriti Gupta's chart of the day. She's here with me in the studio. So, Kriti, it's been a while, but conditions are tightened. The question is, how much further can it go?
Yeah, they really have. And this is a really interesting point when we're talking about simply the commodity shocks and the impact it's going to have, not just on the economy, but on the markets. And of course, we have seen that major sell-off, that sensitivity in the stock market to those oil shocks. But take a look at this from a historical perspective. We're looking at the U.S. Financial Conditions Index. It's a pity Tom isn't here. He loves this index. But if you go back to the 1990s, you can see that a lot of these commodity shocks have actually hit those financial conditions before those even recessions did. Over in 2008, you saw those conditions already tighten before the actual crash. The same story in 1991 during the Gulf War, when you saw that commodity shock really take a hit. Compare that to what you're seeing in the markets right now, and actually the move that seems so strong, so aggressive to the downside more recently, compared to history, and it actually isn't that bad. But that being said, it's just the beginning, and we have to see if commodity shocks actually have a bigger impact for the rest of the year.
Kriti Gupta, thank you so much. Too short a visit. Right now, though, you're talking about the commodity shock. Let's get more on that with Javier Blas, who, of course, covers all things commodities for us for Bloomberg Opinion. And Javier, I'm looking at the whipsaw action that we've seen in oil. The decline this week has been dramatic. What do you make of the volatility? Aside from just the fundamentals, is there something telling about the financialization of this market?
Yes, I think that you are right. It goes beyond the fundamentals, because the fundamentals for the oil market remain extremely tight. If you look at supply and demand, what is happening physically on the market will suggest that prices will be higher. But looking at the financial market for oil and refined products, what we see is very, very thin liquidity over the last few days. And we are seeing most traders really behaving like they need to take care of their value at risk, of their balance sheet positions, of their margin calls, rather than what they see on supply and demand fundamentals. Many people have taken risks from the table, and they are just trying to protect their balance sheet.
Javier, on the issue of supply, we heard from the U.S. Energy Secretary Jennifer Granholm speaking on CNN, encouraging shale basically to pump more, saying oil companies need to be sensitive of the situation and step up and increase supply. Even if shale players wanted to serve at the pleasure of the president and of the Biden administration, do they even have the capability of doing so?
Well, we call shale short cycle, but it's not that short. It takes weeks and months before we can see a reaction. So even if shale was to start drilling today and have any impediments for that, we will not see the oil at the earliest until the late summer. But shale faces many obstacles to increase production. They are facing some of the same problems that the rest of the economy. Supply chains are difficult, and the labor market is very tight to get workers into Texas, New Mexico, Oklahoma, and the areas that you need. But I think that one thing that the administration wants from the shale industry is not much that they really throw themselves and they work at the pleasure of the White House, but at least they send the message that they are going to be increasing production, and that at $100 plus dollars a barrel oil, they can increase production. I think that that's what the White House wants.
Javier, how much of a head fake is the decline that we've seen in oil this week?
I'm particularly surprised about the decline this week. I look at the physical market; it feels a lot tighter. That decline in prices will suggest probably the jump to all the way above $130 was overdue, but trading below $100 with the risk that we lose more supply from Russia without having a deal with Iran yet in place. And also, let's not forget, we are at the lowest point of demand of the year. This is traditionally when the time when refineries are doing annual maintenance, preparing for the increase in demand that comes through the spring and summer in the northern hemisphere, which we will see demand increasing significantly around 3 million barrels a day from now all the way until early September. And we are also still drawing inventories, even if this is the time that we will sort of be drawing them. So everything on the physical market points to a really tight market, and yet we have seen a big drop in oil prices. That's really puzzling.
Javier Blas, thank you so much. Too short a visit as well. A Bloomberg Opinion, always wonderful to get your insights. I've got to say the oil story and the oil shock, Kaylee, has led to such a flip-flopping in all of the messaging in terms of the commodity shock in the United States. How much do you get this to become a relief as you start to see the prices come down at the pump and then people start talking about the runaway inflation versus a Fed that's tightening too quickly?
Well, of course, the price at the pump is maybe the most obvious view on inflation Americans have, because you can see the numbers changing each and every day. Obviously, that operates with a lag when it comes to the price of oil. But on the fluctuations, Lisa, is this just a market that has absolutely no idea how to price the scenario, with so many questions remaining around the situation between Russia and Ukraine, how long that war is going to last, especially with the Kremlin now pouring cold water on the idea that progress has been made in talks.
And right now, the only certainty that a lot of people have is that rates are going to be a lot higher than they were a couple months ago, perhaps not that they have been historically, but that even with a bit of a retracement today, still notably higher than where we started 10 years solidly above 2% now, 2.15%, with a lot of people expecting further moves, especially if the Fed gets their way. Coming up on Balance of Power on Bloomberg TV and radio, former U.S. Secretary of Defense Leon Panetta. From New York City, this is Bloomberg.
Welcome back to another special BNP Paribas Open Update for Bloomberg TV and radio from Tennis Channel. I'm Jamie Maggio. Raphael Nadal kept his perfect record this year intact with a hard-fought win over American Riley Opelka. The 21-time major champion putting his 18th win in 2022 in the books to reach his 98th career quarterfinal at a Masters 1000 event.
Well, I think I played my best match so far in the tournament, no? So I needed today, so very pleased the way that I managed to win that match in two difficult tiebreaks. So yeah, this victory means a lot to me.
On the women's side, 2015 champ Simona Halep moved on to the Final Four with an impressive straight sets win over Petra Martic. The two-time major champion reaching the semis in the desert for the first time since 2018. And don't forget, Tennis Channel's extensive daily live coverage from Indian Wells all starts at 1 p.m. Eastern.
Delhi airport, and behind me you can see SpiceJet 737 MAX aircraft. SpaceJet chairman Ajay Singh earlier today said that Boeing is going to compensate SpiceJet in form of cash and aircraft. There's a big celebration happening at the Gwalior airport. As you can see, they've literally rolled down the red carpet for SpiceJet chairman Ajay Singh. There are balloons, there are flowers. This is a big deal for SpiceJet because it is the only Indian operator of Boeing 737 MAX planes currently.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Live from New York City for our audience worldwide. Good morning, good morning. Following the biggest two-day pop on the S&P going back to April 2020. Equities a little softer, 20 minutes away, 30 minutes away. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Live from New York City, we begin with the big issue. We have liftoff.
We finally got the first Fed rate hike of this cycle. These 7 hikes for this year.
All the forecasts were not particularly encouraging.
It's unrealistically hawkish what they've put out yesterday.
The numbers don't add up.
I can't add these numbers up and make any sense of them.
I don't think they believe it, to be honest.
I think of it as cloud cuckoo land.
That is true that we need to get rid of inflation.
In reality, as I think time goes by and we see the consequences of a few hikes, the growth aspect will become more real.
It's fanciful to think that we don't see an increase in the unemployment rate.
At this stage, I mean, it's easy to talk is cheap.
Inflation isn't embedded. The expectations are not embedded.
This is all fantasy land.
This is all fantasy land. Joining us now, Crossmark's Victoria Fernandez, Morgan Stanley's Matt Hornback, Gene Tanuzzo of Columbia Threadneedle, a fantastic panel post-Fed. Victoria, is this all fantasy land?
I think a lot of it is. I mean, Jonathan, you know my viewpoint going into this Fed meeting, and I never thought that the expectations of 7 or 8 rate hikes was going to be something that the Fed would buy into, but yet here we are. We have the dot plots that show about 7 rate hikes built into that. And you look and say, what, 2.8% by the end of next year? That just doesn't seem right. And I think the market yesterday, the reactions that we saw tell us that people were quite confused. You have a 2-year skyrocketing, you have a dollar falling, you had transports move higher, you had flows into staples increase. So it was just all these mixed messages going on. And even though I think the rally in the market yesterday was probably because we got past this first rate hike, we got past this one uncertainty of what the dot plots were going to look like, I still think there's confusion. And I agree that I don't really see this playing out the way that it was laid out yesterday. I think the Fed's going to have to end up being a little more dovish than what was planned for yesterday.
Standard Chartered agrees. They say we are less convinced on the underlying strength in both demand and labour markets, so remain sceptical that they follow through with their full hiking programme. Gene Tanuzzo, I have to say a consensus formed pretty quickly. We heard there from Diane Swong, she said it's fanciful. Scott Minard said we're in fantasy land. Do you agree?
No, I actually don't, John. I think if there could be a headline to the Fed meeting yesterday, it should say, mission accomplished. I think Jay Powell was sitting here 2 years ago, staring into the face of the biggest disinflationary force that we've seen, certainly since the great financial crisis and perhaps ever. So I think, sitting here 2 years later with a V-shaped recovery, the unemployment rate below 4%, and inflation rising, it was the easiest thing in the world for them to step up and say they want to hike rates by 25 basis points. So I actually think the market response was quite reasonable. And if you look at the long end yields being stable, short-term interest rates rising because the Fed hiked rates, and risk assets doing well, I think that's mission accomplished.
Gene, that's not the bit that they think is fancy land. The bit they think is fancy land is not the 25 basis point hike. It's getting it to 1.9% year end, 2.8% year end 2023, and doing that with unemployment staying at 3.5% and throwing some balance sheet reduction as well. Do you think that's achievable?
Well, no, but I also don't think those are useful in terms of our investment decision making. The Fed's not in a position to predict or forecast a higher unemployment rate. There's really not a framework for them to do that. At this point, they've solved or they've accomplished the labor market objective for now, and they'll react to changes in the unemployment rate rather than really be able to influence them.
Matt Hornback, what was your take?
Look, I agree with Gene. I think mission accomplished. I also don't think that what the Fed is suggesting they may do later this year is fantasy land. I think what's fantasy land is that, people think that inflation is going to come all the way back down to earth because of some, marginal improvements in supply chains. I mean, at the end of the day, inflation is not just about supply, it's also about demand. One of the things that struck me as somewhat fanciful in the Fed's forecast is their growth forecast for this year. I mean, they've got growth coming in real terms below 3%. Morgan Stanley economists are way above that. And so we think the economy is going to be quite strong this year. I think if that ends up being the case, even with some marginal improvement in supply chains, which of course has now been thrown into question given the conflict in Ukraine, then I'd say there probably still is upside risks to inflation. And by the way, that's exactly the Fed's perspective at this point. So if they get, if we get the growth that we're expecting here at Morgan Stanley, and the Fed gets the inflation that they're expecting, they almost certainly are going to hike rates at every meeting this year, and people will have to change their tune on just what fantasies they're dealing with.
Mike McKee, it sounds like we have a range of opinions here. Mike, you heard what people said to us yesterday. Matt Hornback, Gene Tenuzzo taking the other side of it. Mike, all signs are that this is a strong economy. Chairman Powell's words. We do feel the economy is very strong and well positioned to withstand tighter monetary policy.
Yeah, well, we're watching the Fed chairman, and we're going to be watching the economy and see how their forecasts turn out. But I want to start by taking you back home, across the pond to England, where the Bank of England today raised interest rates for the third time in a row. They're walking the walk that the Fed is talking, but take a look at the top line there. That's inflation expectations. They're raising rates and expectations are still going up. Governor Andrew Bailey is seeing what Jay Powell does not want to see, which may be something that is behind their forecasts. Take a look at what they are talking about, and you've gone over the numbers pretty well. Unemployment's not going to rise, GDP's not going to fall below potential, and inflation is going to magically come down. I'm not calling it Fantasyland, I'm calling it Alice in Wonderland. The Fed funds rate is going to go above neutral, and all of this is going to happen. It may be more performance art than anything else. The Fed doesn't know what's going to happen down the road because of the war, because of COVID. That's not over with. And so they're going to overpromise to keep the markets from getting over-concerned and try to keep those inflation expectations anchored, and then they'll see down the road if they need to do 6 or 7. You take a look at the dot plot, and you can see how it has moved over the last 24 hours to the right there and higher. The light green line is where the market thinks rates are going to be if you look at overnight index swaps. And so the Fed has positioned itself even more hawkish than the market at this point. But what you look at is on those white dots, the big spread in 2023 and 2024 shows the Fed is not at all united on what needs to be done. So there's a long way between here and getting everything that we saw in their forecasts. And the Fed may not go that far, but they, at this point, want to control the narrative.
Mike McKee, thank you. Let's talk about how to push this through the bond market, the yield curve. Victoria, 2s, 10s, the spread between the two, 22 basis points. 7-year yields are above 10s. 5-year yields aren't far behind, and neither are 3-year yields early this morning. Are we facing some curve inversion through the next couple of months?
Well, I mean, and we've got a little bit of it already. And even yesterday during the press conference, you could see some of those inversions happening. So do parts of the curve invert? Yes, I think they do. And so that's when you have to really start looking at where are you buying? You have your duration call in your fixed income portfolios, but where on the yield curve do you want to be, right? That's part of our investment process for our fixed income portfolios. But clients keep asking us about that. What happens if the yield curve inverts? At our investment committee meeting last week, we actually sat down and said, let's forget 2s to 10s. Let's look 3-month to 10, because that's where we think you really get some of the technical movement when it comes to recessions following an inversion. You look a week and a half ago, that was around a 140, 145. This morning, it's 170. You actually got steepening in the 3-month to 10-year part of the curve, which I think is quite interesting as you get everything else flattening. So there's some confusion, in my opinion, in what's going on in the yield curve. I think we need to give it a little bit of time to flatten out, but I will tell you we are extending duration a little bit right now. We've been short for a long time because we do think that 230, 240 range is probably going to be the peak, regardless of the news that came out yesterday. I think you're looking around 230, 240 on the 10-year before we start to see yields coming back down.
Matt Hornbeck, your reaction, sir?
Well, we very much are in the flatter curve camp, John. I think this curve is ultimately going to end up inverting by more than we have seen certainly in my career, and I would argue for probably a couple of decades even before I joined the business. I think we're going to end up seeing a much flatter yield curve, John. And ultimately, you know, it's not going to come by way of conundrum, right? This is not the 2004 to 2006 experience when we had a tremendous amount of capital inflow into the U.S. weighing on longer term yields. You know, this is really a combination of some overseas demand, yes, but you know, you've got tremendous central bank balance sheet stock here that's weighing on the long end of the curve. And we've got solvency ratios in the pension fund industry that keep going up, John. So you're going to have a tremendous amount of demand for the back end of the curve. It's going to end up flattening the curve quite a bit, I think.
Gene, final thoughts?
No, I think that's right, and Victoria said it very well. There really is a lot of positive slope still in the curve. If you think about, you know, the Fed funds rate at 40 basis points and the 30-year at 240 basis points, there's a lot there. But we have to remember that it's only been really about 10 years that the Fed's been giving us these summary of economic projections, or the dots. So all of a sudden, those first 2 years have a lot more clarity. And so when we start to look at things like 2s, 10s, I don't think it gives us the reliable signal that it gave us before. But, you know, as we go forward, the Fed indicated a pretty consistent path of hikes. It's hard to see the curve not flattening in that environment.
Gene Tenuso sticking with us alongside Victoria and Matt. About 20 minutes away from the opening bell. Let's get you some movers. We can do that with Abby.
John, well, after the best 2 days for the S&P 500 since April of 2020, as you mentioned, today we're taking a little bit of a breather. U.S. futures are lower and in a broad-based way, leading the way to some degree. And from a point standpoint, Apple coming in after a 7% 2-day rebound rally. That for the NASDAQ 100, but Apple a big piece of it, and that's the best for the NASDAQ 100 since November of 2020. The travel trade unwinding too, with with oil popping back above $100 per barrel. United Airlines down 2.5%, and the banks with yields in just slightly, weighing on the banks, down 6.1%. And then there's Warby Parker, the eyewear retailer, is plunging, although off of its 20% pre-market lows. This, John, on a net revenue miss and weak forecast. There is one sector higher. We'll be talking about it later. That is energy.
Looking forward to that, Abby. Thank you, with that big move in crude again today. Coming up, Russia denying reports of major progress in peace talks.
The Russians, for all the talk about wanting to find a diplomatic path forward, we haven't seen them act on that.
That's next. This is Bloomberg.
Omicron variant and the latest wave have an impact on not only consumer trends, but your business? And do you expect the booster shots to make a difference?
Yeah, booster shot will make a huge difference. I think it's been accelerated by the huge leadership of the current Prime Minister Kishida. And I'm hopeful that our business will come back in Japan around perhaps mid-February to end of February, because we expect that a peak time will come around that time. And then the government will shift toward the reinvigoration of consumer. That will help us. And we had seen the huge comeback of the business in December when the things were toward the normalization. So I believe the business will come back, and I'm very much hopeful.
However you get your news.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia.
This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
The Russians, for all the talk about wanting to find a diplomatic path forward, we haven't seen them act on that. What you're seeing by the Russians on the ground is a full-on commitment to military operations. The fighting continues, the death and destruction continues.
Mixed messages, loads of them emerging amid talks between Russia and Ukraine. The Financial Times reporting the following in the last 24 hours. Ukraine and Russia have made significant progress on a peace plan, including a ceasefire, Russian withdrawal if Kyiv declares neutrality and accept armed force limits. The Kremlin denied the report. They said the following: on the whole, that's wrong. When there's progress, we'll tell you. Team coverage starts right now. Anne-Marie down in DC, Maria Tadeo in Brussels. Maria, great interview with John Kirby earlier this morning. Can you tell me where we are in these talks right now?
Well, you heard it right there. He did say the words coming out of the Russian Federation do not match the actions on the ground from the Russian Federation. We continue to see a huge military deployment in Ukraine. We continue to see cities that get bombed and shelled every day. Yesterday, there was a big operation in the city of Mariupol. Remember, this is the place that connects Crimea to the Donbass, and it's a major, major fighting ground for the Russians, and that continues. He also made it clear that for Ukrainians, they want to see a ceasefire before the real talks begin, and that ceasefire is nowhere to be seen. When it comes to the troop pullback, it's been the opposite. Russia continues to engage not just men on the ground, but also, remember, Jonathan, the real damage is being done from the sky. It's aircrafts, it's fighter jets that continue to bomb the crowd of Ukrainians. So a lot of this, of course, you could talk about talking neutrality and so on, but on the ground, this is still a war that's going on for 22 days.
AMH, really important talks tomorrow. They don't involve Russia or Ukraine. It's the President of the United States with Xi Jinping of China tomorrow. How important is that?
I think it's incredibly important given the fact that the United States is trying to get China on board to influence President Putin. This also comes after a number of reports we have that Russia is seeking that help from Beijing, one on the military front, but also on the sanctions front. They want us to be able to do trade and business with China. It also comes after that high-level talks between Jake Sullivan and his Chinese counterpart in Rome that really is setting the stage for these talks. But now you have leader to leader, and Jonathan, they haven't spoken since November. So this is an incredibly important call for the president to make sure and to attempt to try to get China on side with the United States, because China, of course, is not there from straight up diplomatic on the surface level, but also the undertones of potentially are they going to come to Russia's rescue.
AMH, thank you. Down in DC, Maria Tadeo over in Brussels. Crude this morning up 7% on Brent, just short of 105. On WTI through 101, let's call it 50, up 6.7%. Morgan Stanley with their forecast at 120 for crude, 120 in the third quarter. They say the following: to say that oil prices have been volatile recently would be an understatement. It will likely become progressively more difficult for Russia to maintain its seaborne exports in the coming months. Victoria Fernandez, have we fully realized the risks associated with this story? And what would you look for to give you confidence that that's the conclusion?
Yeah, you know, Jonathan, we were underweight energy last year, which from a market perspective did not work out well for us, but we were adding some in the beginning of the year and that was good, but we've started to trim because there is so much uncertainty going on there. Is it fully priced in? Have we appreciated all of it? Probably not. I mean, the question is, you've got tankers on their way here already with Russian oil. Do we close the ports to them? What happens then to the companies that have paid for that? And then the tankers sit out in the ocean, and what do we do with that? You have Russian oil that is going to be priced so cheaply that do companies still continue to turn a blind eye to that because of political issues? I just don't know how this is going to work out. There is such tremendous volatility. We spoke a couple weeks ago and we thought, oh my goodness, oil could get to $100. And then it got to what, 130, 140. And now we're back again right at 100. That's a lot of movement going on there. We knew there would be volatility in this sector. I don't think we knew it would be quite this much. I would be very cautious here until we see things play out a little bit more. This meeting with China, I think, plays into this as well. How much is China going to step in and help with Russian oil and taking some of that that volume there? I just don't have an answer to it right now, but our suggestion would be to be cautious.
Tomorrow is an important conversation. Matt, can I come to you on that question too? If you remember COVID and coming out of the pandemic, even in the pandemic, at some point this awkward transition evolved, and I think it is awkward. The market starts to live in a better future, hoping for one anyway, even with the devastation that continues right in front of our faces. How would you identify when a market is starting to move past a tragedy like this one?
I mean, John, it's really a wonderful question. I don't know if there is one answer to that. I mean, at the end of the day, time tends to heal all wounds, but again, it kind of depends on how big the wound is. At the end of the day, what we're looking for, John, is signs that the increase in prices that you see for energy, ultimately that end up affecting consumers. You know, to what extent do those incomes that consumers are bringing in through either new jobs or just general increases in wages, you know, how do they deal with that? You know, are those increases in wages enough to offset the higher prices at the pump? I mean, these are important things, and there is uncertainty around this, John, which is, I think, ultimately why you see a lot of disagreement or at least uncertainty in the Fed's projections for policy this year.
Gene Tenuso, the lack of visibility and clarity about the year ahead, is that a big topic of conversation where you sit?
I think it is, absolutely. And I think we have to remember here, John, tightening is happening right now besides just the Fed funds rate, right? So we know the short-term interest rate has risen, but lost in this debate about whether the Fed should hike 25 or 50 basis points is the fact that we'll also see the balance sheet start to run off probably at the next meeting. We're also seeing financial conditions tightening, and we're also seeing the biggest fiscal drag that we've ever had in this country post-war. So I think the drags on growth are real, and when you talk about these shocks, whether they be from Russia and Ukraine or perhaps what could come if things got bumpy with China, those shocks are real, and I think are things that the Fed is going to have to deal with perhaps in the second half of the year when there's not quite so much economic momentum.
Gene, you said something so important 10 minutes ago about the summary of economic projections. Not only did we used to get by without that, we didn't have a news conference, we didn't have a statement. When that was introduced, it was introduced to help ease, to help reinforce forward guidance. It was as if to say, look, where we think rates will be for the next few years, they're going nowhere. Price that in. Then when we started to embark on tightening cycles, what developed, as you know, Gene, is that we used to take the dot plot, front load the rate hikes, financial conditions would tighten, and the Fed would have to back away before they could do any of that. Do you think this time is somewhat different?
Well, I think we have to remember how the Fed affects financial conditions, right? Essentially, they can affect, forward guidance is a very powerful tool through which they can influence financial conditions. The dots are a very important communication tool for their forward guidance. But the dots are much, much more effective as an easing tool than they are as a tightening tool. So as we're trying to price in additional hikes, it's really just a summary of the current state more than it is, I think, an accurate projection of where yields must go in the future. Look, we realize that inflation is high and the unemployment rate's low. So those dots that you see on the screen are the projection you have to have given the state of the economy as it sits today.
Gene Tenuso, Victoria Fernandez, Matt Hornback, sticking with us through the opening bell, I'm pleased to say. Coming up, the morning calls, and later, JP Morgan, Bank of America Citi, pairing gains after surging on the Fed's rate hike and the move we saw in yields yesterday. JP Morgan down about 0.5%, B of A off by 0.4, Citi down by a similar amount. The opening bell just around the corner from New York. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Minutes away from the opening bow, 2 days of gains. We pulled back a little bit, down 0.4% on the S&P 500. Fascinating moves in the bond market, 2s, 10s and 30s. 10s last Thursday, lower the session, 190.96. Look where 2s are now. 2s are above where 10s were just last week. 2s right now, 193.44. And the spread between the two, about 22 basis points through much of this morning. It's got tighter and tighter over the last few weeks. Year to date, much more so. We've gone from 70 at the start of the year all the way in to the low 20s and had a little look at 18 earlier on. That's the price action here at the morning calls. JP Morgan upgrading Ralph Lauren to overweight, seeing the company's regional revenue mix offering relative brand insulation. Wedbush raising its price target on Williams-Sonoma to 200, noting the company reported fourth quarter results that handily beat on the bottom line. And RBC downgrading Union Pacific, seeing the relative volume performance gap narrowing on near and medium-term factors. Up next, the opening bow with a big focus on the big banks.
Energy prices and a short supply of key chemicals that produce synthetic fertilisers
are sending pig, cow and horse manure prices soaring. Even human waste is in demand as farmers hunt for alternatives. Fertiliser helps increase crop yields.
You can see how much moisture is held into this. It's a lot of organic material into the compost, so it breaks down. The manure and the straw breaks down into a friable mix that can be mixed into your soil in the ground and for growing a whole range of different vegetables. Holds the nutrients in, holds the water in, and it really increases the kind of biodynamic profile of the soil.
The recent price spike could mean more farmers going organic for the long term.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
The biggest two-day pop on the S&P 500 going back to April 2020, and we pulled back just a little bit on the S&P, negative 0.5% on the Nasdaq. A similar move, down 0.6 on the Russell, down 0.5% as Russia pushes back against this idea. We've had a major breakthrough in talks. They say the report from the FT is, quote, wrong. That's the opening bounce, switch up the board and get to the bond market. What a move we've seen on 10s, on 2s as well. Your 2-year yield much higher than where it was at the start of the year. The last time the Fed met, 1.15 at the close. Yesterday, it came very close to 2% on a 2-year. The 10-year down to 2.15 this morning, down a couple of basis points to 2.1563. Euro dollar punching back through 110, 110.62, up 0.25% on that currency pair. And look at crude go, up more than 7 percentage points to 101.83. Around the opening bow, 25 seconds in. Here's Abby.
John, we of course are looking at a little bit of a consolidation of that big 2-day rally being led by some of the mega cap tech names, including Amazon. Not in a big way, but again, the point constitution to the indexes is what counts, down 0.6%. Tesla down 0.9%. That amid news that they have halted a bond sale backed by auto leases with all of the market turmoil. And I should note, Amazon, they have actually closed that $8.5 billion MGM acquisition in the race for content in the streaming wars. But you were talking about energy, there it is. ExxonMobil up 1.8%, Occidental Petroleum up 5.1%. Energy, one of two sectors, as you know, higher. The rest are lower, John.
Abby, the big winners of the session, the big winners of the year so far. The big banks reversing some big gains off the back of a more hawkish Fed. For more, I want to bring in Kaylee Lyons. Hey, Kaylee.
Hey, John. Well, the banks are declining today, and I would point out they've been declining for a large part of the year so far. Through Tuesday, the KBW Bank Index was down by about 5%, but it did reverse a good deal of those losses yesterday post-Fed decision. It was up 3.6%, so cutting those losses down to about 1.5% on the year. When you look at one stock like JP Morgan, it was up 4.5% on the day yesterday. Its best day since January. The reason why, pretty straightforward, John. Banks generally consider beneficiaries when rates are higher because they can charge more for what they lend. And not only did the Fed raise rates yesterday, it signaled many more hikes to come. In fact, potentially 6 more this year and more the year after, ultimately getting to 2.8% by the end of 2023, if you believe the dot plot. So in theory, that should benefit the banks when it comes to net interest income, which is the primary revenue source for most of the major players. It's 58% of revenue for Citi. It's roughly half for Bank of America, Wells Fargo, and JP Morgan. Obviously less important for investment banking focused Morgan Stanley and Goldman Sachs. But the point is, higher rates should help out the fundamentals for these companies. The question is, John, at what point do higher borrowing costs actually hurt demand for loans and start to turn things in the other direction, John?
Kaylee, that's the US. In Europe, they've got other problems, bigger problems. And you know what that begins with? Russia. This was the line from Intesa Sanpaolo yesterday that Russia-Ukraine loan exposure totaled about 5.1 billion euros. Moments ago, Intesa said this, the CEO signaling the 22 profit goal is at risk after the invasion. Going on to say, though, that they have no plan to postpone the 22 share buyback. So that's just come from the Intesa CEO moments ago. That stock just a little bit softer on the session so far. Let's go back to the financials in America. Larry Adam of Raymond James said this. One of the catalysts is interest rates moving higher, and that's going to help lift the expectations of what the sector can produce from an earnings perspective. Victoria, I want to come to you on that. There's two things at play here. I think the 10-year kind of sets the tone for how investors allocate towards the financials, but when you're talking about profitability, isn't it somewhere else?
Yeah, well, I mean, you have to look at the shape of the yield curve. We were talking about that earlier, and as that gets flatter, you want to look at that difference between the short end and the long end, and that comes into play a lot more for banks than probably just the 10-year rate by itself. Saying that, though, you know financials are one of our favorite sectors so far this year, and last week and even earlier this week, we were adding to some of those names. We were adding to Bank America, we were adding to Visa and MasterCard, because I do think we're going to continue to see some improvement in these names throughout the year. Obviously, yesterday was a really strong day with what we saw out of the FOMC meeting. But even going forward, I know Kaylee talked about loan growth, and is that going to dampen with consumer sentiment coming down? We don't think so. We think we're going to continue to see loan growth continue. You look at household balance sheets with revolving debt, and there is plenty of room for the consumer at the consumer level to go in and do loans and increase their debt as well. You've got really strong balance sheets for these banks. And I mean, you look at Bank America, there's a 2% dividend yield there. So I think they're sitting in a pretty decent position. Now, again, this is US banks, not European banks. That's a different story. And you look at where they sit in regards to the Russia issue. Bank America is pretty good in that situation. We know Citi had some exposure. You also have to look at counterparty risk in regards to commodity futures, and Bank America sits well there. Morgan Stanley is probably one that has a little more issues. So for the sector overall, we're pretty confident for them going forward.
You like the banks, and the reason you like the banks is usually the reason people don't like big tech. Dan Ives of Wedbush said this yesterday following the Fed call. He said, in a nutshell, we believe the tech sector is as oversold as we have seen in the last 5 years, and we would strongly be buying cloud software, cybersecurity, chips, and stalwart tech names here led by FANG, with Apple and Microsoft our clear favorite large caps. There is one view, Victoria, shared by some, that the Fed can't get much more hawkish than this. They've implied what they can do, 1.9% year end, 2.8% next year, balance sheet reduction. And for that reason, given what's happened with tech already, buy. What do you say?
I don't disagree with Dan at all in his statement. I mean, we've actually been adding to our Apple and Microsoft positions, buying some other tech names, because we do agree that that sector has been oversold. And you don't want to have zero growth exposure, zero tech exposure in your portfolio. So you look at those names that have come down significantly, 15, 20, 25% year to date. I think you go in and you have that opportunity. You buy those names and put them in your portfolio. You know, Dan mentioned Apple and Microsoft, and I said those are two names we actually have bought over the last couple of weeks. So I think you use it as an opportunity for exactly those reasons.
Gene, allow me to play devil's advocate. We've got a yield curve that a lot of people think will invert. Matt's talked about that earlier this morning already. Consumer confidence, shaky. A Fed that's going to try and reduce the balance sheet quickly, more quickly than last time around. Interest rates higher, and higher potentially than last time around. Why do I want to own risk assets in that world?
Well, look, we have to remember those growth headwinds are there. So I don't think we have a free pass to add risk across the board in portfolios. But we've had a significant repricing in the last 6 months. And the example I would use is U.S. investment grade credit, particularly at the long end of the curve. We've had spreads widen materially at a time when yields have risen as well. So you've had investment grade long duration bonds down 15% or so in the last 6 months. We think this is a buying opportunity when the Fed is giving us some comfort that the long run dot is in the realm of where the 30-year Treasury yield is at this point in time. Credit spreads are wider, and these are the companies with the strength of balance sheet that in the fullness of time will do well through this cycle, as opposed to the riskier, high yield, highly levered companies.
Gene, any particular industry groups within IG that you prefer? Anything there at all?
Yeah, you know, Victoria brought up the banks, and actually in fixed income land, they're particularly attractive right now, I would say more than they have been in a long time. A lot of that is not because of fundamental weakness, but because of the supply and the technical picture. There's been a lot of new issuance. And so that's really pushed the sector wider, I think, for reasons that are temporary in nature.
Matt Hornbach, you wrote about the hedging properties of the long bond, and we haven't touched on that much this morning. Can you go there now, Matt? Can you talk to us about why that might be the place to be?
Yeah, well, John, you know, one of the things that we've been following for some time now is the increase in funding ratios for the U.S. corporate defined benefit pension plan community. And one of the things that Gene alluded to in his comments with the increase in long-term interest rates, the widening in credit spreads, that has actually boosted the discount rate for corporate pension liabilities. And so even though there's been a little bit of weakness in the equity market since the start of the year, you've actually seen these solvency ratios continue to march higher for corporate pension plans. And so ultimately, this is putting them in a really good position to de-risk their portfolios. Now, this is not something that they're going to do at one point in time and then never do again. There is a glide path here that a lot of pension plans follow, but at the end of the day, as long as that funded status continues to improve, you should continue to see demand coming out of the equity market into long-dated fixed income for that particular community of investor. And that's in addition to the large stock of securities that the Fed has removed from the marketplace. So that's one of the core features of a curve flattener that we've been advocating for some time now.
Matt, how do you think the curve's going to respond to the eventual balance sheet roll-off we're looking for, the QT, so to speak, in the coming 18 months?
Well, John, I think what is the consensus expectation for that process, which is a passive process, is more or less in the price of the bond market already. I mean, there may be some slight, kind of differences in people's opinion over the specifics of the program. Where will the caps be set? How quickly will the Fed get to those caps? When exactly are they going to start the program? Gene suggested May. We think that's certainly within the realm of possibility. So, there's some differences in people's views there, but by and large, everybody knows it's going to get going by mid-year. And so that's more or less in the price. What's not particularly in the price is if the Fed decides to sell securities at some point later this year, that would not be in the price. And then you would see the yield curve respond to that.
Matt Hornbach, great work as always, buddy. Good to catch up. Victoria Fernandez, June Tenuto, thank you to the three of you. This is a really tough moment to make a call on what outcome we're going to get. Aaron Kennan at Clear Harbor wrote me a message yesterday on Twitter. He said the following: the dilemma for many investors at the moment, allocate capital towards the inflationary picture or allocate to the increasing likelihood of lower growth and incrementally higher unemployment. I suspect the likely outcome is higher vol and lower valuations for now. A range of opinions. There's one. I'm looking forward to catching up with Aaron a little bit later through the next month or so. Coming up, President Biden ramping up military aid to Ukraine.
Now I'm once again using my presidential authority to activate an additional security assistance to continue to help Ukraine fend off Russia's assault.
That's next. This is Bloomberg.
know that it's highly transmissible. We know that 2 doses of vaccines, Pfizer vaccine specifically, neutralize the virus, but not as efficiently, because various studies showing that reduction up to 40-fold, meaning that a 3rd dose is a must for it to successfully neutralize the variant. What we don't know is still that what are the effects of mix and matching between vaccines, and what are the capabilities of antibodies produced from this mix and matching in neutralizing Omicron. Because as we know, many parts of the world use different types of vaccines. And that would be a great data to look at. It will be also great to look at, because majority of the studies done uses a small sample number, and most of the time when you translate it to real world, the data changes. So it will be really good to look at large-scale data of the ability of antibodies from vaccines to neutralize this variant. Grateful here today that the virus, Omicron variant, still uses ACE2 receptor as its main entry. It means that all of the vaccines which are designed with spike in mind still works. Imagine if it uses a different receptor other than ACE2. None of the vaccines would work today. So I think that is the best news that we got from all these studies which came recently, the past couple of days.
Lots happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Once again, using my presidential authority to activate an additional security assistance to continue to help Ukraine fend off Russia's assault. An additional $800 million in assistance. That brings the total of new U.S. security assistance to Ukraine to $1 billion.
President Biden expanded the arsenal for Ukraine as Ukraine's leader pleads for more aid, more military aid, and more sanctions. Those sanctions are already hitting Russia. The default countdown kicked off already this week. The bond payment is still in limbo from yesterday, 2 interest payments, about $117 million. Bloomberg's Mark Dowding said this: expect the pain to last. Russia will be in the isolated wilderness for a long time to come. A regime change is probably a prerequisite for reinvestment, along with lifting sanctions. Damien Sassower of Bloomberg Intelligence is back with us. Damien, go on the reporting and let's work out what's happening here. Have they sent the money over towards the investors and through the bank?
So my understanding is that Finance Minister Sulanov, Russian Finance Minister Sulanov, did indeed send the dollars to his correspondent bank for payment on to Citigroup of London, who is the payment bank that has to make payment to creditors. We've heard nothing from Citigroup. We don't know if they've actually taken in that money, if they're actually going to pay that money. We know that Citigroup's back office has had some issues in the past. Revlon, for example, they made an erroneous payment, about a year ago. But that's neither here nor there. The reality is we just don't know if they're able to make those payments. We don't even know if they've received them at this point. But let's just say, for all intents and purposes, Jonathan, that they have received the money and they're going to pay the creditors. Well, then we look backwards and forwards. We look backwards to March 2nd when Russia defaulted on its OFZs, its local debt, and assuming what Fitch says, there's a 30-day grace period on that, unconfirmed. That takes us through to April 2nd, and that may constitute a default. And we all look forward to April 4th, when $2 billion of principal are due on Russian bonds. And so, yeah, the game goes on, and it's just like a shell game here,
This can get messy quickly. We don't know if Russia sent the money. We won't have confirmation of that until the corresponding bank can actually say we've received the funds. We have to take their word for it. Some people might be unwilling to do so. Can we go on the theory just for a moment, Damien? Theoretically, can the corresponding bank accept that money from the Russian sovereign?
I mean, I don't know. I mean, look, they can if they get special dispensation. If the government, I mean, this is kind of what's going on here. If the government allows them to receive it, yes, they can, right? But, I mean, according to everything we're reading, everything we're seeing, they're really not able to receive, they're not able to transact with Russian banks. They're not able to transact. So, you know, the verdict is still out, Jonathan. I mean, if you look at some of the, you know, corporates that have paid, Gazprom, Rosneft, they actually had to receive dispensation from the Russian government in order to move those monies to their creditors. So, you know, there are two sides of this coin, and, you know, far be it for me to opine either way. It's just a matter of wait and see, and at this point, we just don't know.
Can I just get some additional clarity as well, Damien, as to whether they did pay that in dollars? You indicated they did. They threatened to pay in local currency.
Yes.
Are they saying they've sent that money in dollars?
Finance Minister Sulanov is absolutely saying that they have every intention of making that payment in dollars. That's a key point because these bonds don't have the fallback optionality where they can pay in rubles.
So how many days left? 29, 28?
29 and counting.
Wait and see.
Yeah.
Do you think we fully realise the consequences of what happens once that grace period passes and perhaps the money doesn't turn up?
Well, you know, Jonathan, I mean, this is a good question because, you know, I think the default is kind of baked in at this point. It's really, what's the real economic impact? I mean, don't get me wrong. There's a lot of offshore creditors that are already marked those bonds down, and they're going to get into a restructuring, a very complex restructuring in order to see just what the recovery is. I think Blue Bay, you know, Mark Dowding actually estimated something in the order of, you know, 25 to 40% recovery when all is said and done. But timing is everything. How long does it take for them to recover, you know, their investment? That remains to be seen. So look, I mean, yeah, I mean, we're sort of in limbo still.
Damien, throw in China as well. Can you tell me how isolated this story is at the moment within EM? Has it started to bleed out?
So
we're seeing waves, ripples.
So yeah, no, we are. I mean, look, if Russia's been kicked out of all these bond indices, right? So that means two things. Who's going to take the place of Russia in these indices? So going forward, high-yielding emerging markets like perhaps Egyptian local bonds or Indian local bonds, both of which are being added to bond indices, or that process is ongoing as we speak, they should benefit from this. Also, forward, and on the flip side, those EM local debt markets that are most liquid, most heavily weighted in indices, China, Indonesia, and Thailand, are most at risk because if you can't sell your Russian bonds to meet your redemptions, you're going to sell the most liquid stuff in your portfolio, and that's CGBs, Indonesian government bonds, and Thai government bonds, and so forth.
Damien, we've got a lot of work to do through the next 28 days or so, and you're going to make it easier for me. Good luck to you. Yeah. Damien Sassow there of Bloomberg Intelligence. Let's keep it on China, allowing some companies to restart factories amid lockdown in Shenzhen. When is a lockdown not a lockdown? And do lockdowns always look like lockdowns did back in 2020? Paul Donovan of UBS taking issue with that, saying the problem is that people hear lockdown and instinctively think of what happened in 2020. That is not what is happening now. Let's get back to Abby for more. Hey, Abby.
Hey, John. Well, you know, this is really interesting because, of course, on Monday, the sky was falling. 51 million people in China were locked down, and the interpretation was that it was a hard 2020-style lockdown, whereas now it seems as though it's loosening up in terms of what's happening over there as far as what it might mean. And there's a piece of this is the fact that new confirmed cases have actually dropped for a second straight day. On Monday, they were up fourfold over a week, so now it's going in the right direction. And in fact, one Hang Seng economist expects the factory closures in the south and in the north to be just 2 weeks as opposed to what felt like it could be for a long time and really influence the economy. And in fact, that important Foxconn, partially they've resumed some of their Shenzhen production. I don't know if that includes the iPhone plants, but it may. So it seems as though there's some hope for the China economy around these new lockdowns. That could be a reason for why we have this monster rally, historic rally for many of the China indexes. That CSI 300 over the last 2 days up 6.4%. The Hang Seng up nearly 17%. Hang Seng Tech amazingly up 32%. Today, though, taking a little bit of breather. That makes sense because, of course, yesterday, that Golden Dragon Index here in the U.S. up 33%. Its best day ever. I can't ever remember an index being up 33% in one day. So today, some consolidation. But on the other hand, John, oil, as you know, right now at $101 per barrel, above $101 per barrel, up 6.3%. That probably reflects some hope that the China economy is not going to be hit quite so hard by these lockdowns. But on the other hand, John, oil, as you know, right now at $101 per barrel, above $101 per barrel, up 6.3%. That probably reflects some hope that the China economy is not going to be hit quite so hard by these lockdowns.
This ADR story as well, we have not sorted out that audit issue. have we, Abby?
You know, it's really incredible, this volatility, both to the downside and the upside. I would say that the really key point to think of here, though, is that these stocks down 75%, then that monster rally, they barely made up any of those losses. A lot of folks are telling me that it's like catching a falling knife. In fact, I spoke to Paul Ciano over at Bank of America, and he was saying that people really aren't reaching out yet because of that risk. But let's see what happens here. It's pretty interesting, but it's going to depend on these fundamentals, plus the important issue of where China falls on the Ukraine-Russia.
Let you decide. The Hang Seng got more than 7% at the close. The CSI 300 up about 2%. With your sector price action for today's price action, 22 minutes in, here's Kriti Gupta.
Well, good morning, John. Of course, you are seeing some divergence in the markets right now about flat in the S&P 500, but it's really because you don't have tech on your side. In fact, tech weighing the entire market down. What isn't weighing the market down is energy. It is up, and it is up by a lot, up 1.7%. And if you look underneath the hood, once again, it comes down to those favorites, the energy companies that have that extra exposure to U.S. production, Occidental, Marathon Oil, Halliburton, and Occidental getting an extra bid. It's actually your best performer at the moment after some reporting that Warren Buffett is now building his stake up in the stock. 14.6% of the company is just how much he owns right now. And this is really important because, of course, we know that financing for the Anadarko deal came partly from Warren Buffett. And nevertheless, it kind of seems like other investors are taking his lead and really boosting those energy shares, John.
Kriti, thank you. Kriti Gupta on the sector price action. And move on, Brent crude 105, WTI 101. Let me leave you with this one just quickly from Citi and Andrew Hollenhorst. Investors should heed this warning and expect the Fed to continue to raise rates and engage in balance sheet reductions until some combination of higher real rates and lower risk asset valuations are achieved. We expect a 50 basis point hike in May and the announcement of balance sheet reduction as well. The line from Citi this morning. Up next, your trading diary. This is Bloomberg.
Exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
In about 5 minutes' time, Guy Johnson, Gina Martinez picking up on a price action for you, trying to explain the last few days. We're unchanged now on the S&P, on the NASDAQ down about 0.1%. That's the price action. Here's the trading diary. Picking things up with Secretary Blinken speaking on the war in Ukraine at 1:30 Eastern. President Biden and China Xi talking Russia tomorrow. That is a really important conversation. More central bank decisions on deck with the Bank of Russia and BOJ. Plus, we'll hear from the Fed's Barkin and Bauman. The Fed speak, no doubt, will continue next week. From New York City, this was the Countdown to the Open. This is Bloomberg.
this chip shortage is going to last longer than many people believe, likely straight through this year. And I wonder what that means for prices. Will this get worse before it gets better?
I don't know that it will get worse before it gets better, but there's no reason to believe it's going to get meaningfully better anytime soon. The Commerce Department put that data out yesterday, and what it showed is that there's a real shortage. Demand is 20% higher than it was a couple of years ago. There's a huge mismatch in supply and demand. Prices are high. Prices are higher. So what has to happen is we need to make more chips. Unfortunately, there's no easy solution. The solution is increased domestic manufacturing of chips, which is what we need to do.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Business Week about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands. And it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi-Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in sari stores every day, also on TV, radio, and newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number Fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with number fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the streets, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million-peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for number fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, Pepsi goons bomb their own trucks. And when I visited the MBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the Number Fever campaign. Del Fierro thought Pepsi's Number Fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees. But for people who couldn't afford the money, he would just represent them pro bono.
The alliance is to build up pressure on Pepsi. And so you see people marching in the streets. So we have mounted our own campaign, even in the U.S.
He flew to America and he hired two consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi-Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113, also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue a warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complications due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi Number Fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's Number Fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning 1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as the coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. And it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war, so the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund. Everyone is looking forward to it. The team always meets in the same hotel ahead of matches.
They stayed in this hotel in order to have a kind of neutral space before games so that they could concentrate, be sort of isolated from distractions, things like that.
Everyone was pretty optimistic. They had a chance to go really far, maybe into the finals. I was in the office and getting ready for match day. I was going to meet with a friend, a fellow Dortmund supporter, in a pub. As always, the fans are very excited about matches.
On that day, they were heading to play in the quarterfinal against AS Monaco at Signal Iduna Stadium, which is in the center of Dortmund. Shortly before 7 p.m., the players of the team boarded their official team bus.
When the bus took off the parking lot of the hotel and turned on the street, there were three detonations, 3 bombs that exploded and hit the bus of Dortmund.
3 explosions occurred close to the Borussia Dortmund team bus. The B team bus had just left the hotel. The explosions destroyed 2 windows in the rear part of the bus.
People screamed, people jumped to the ground.
The fellow Dortmund fan I was supposed to watch the match with, he called me and said, turn on the TV, there was an attack of the Dortmund bus. And I thought he was like, that was impossible.
Some of the players screamed at the driver to keep driving as fast as possible because they were worried that people might storm the bus.
German investigators say the explosive devices used in the attack on the Borussia Dortmund bus contained metal pins, and that one had pierced a seat headrest.
Unbeknownst to the team members, the actual mastermind behind the attack was, as they were disembarking the bus, was actually eating steak and sweet potatoes at the hotel they had just left.
Authorities are attempting to verify a letter left at the scene claiming jihadists were behind the attack.
Because there had been a series of attacks by Islamic terrorists in Germany and Europe, there was widespread suspicion in the media that this was another Islamic terror attack. 3 letters were found at the site of the bombing that took credit for the attack on behalf of Islamic State. There were, however, reasons to doubt this particular narrative.
Would actually be a surprise if ISIS were actually part of this attack. Possibly could be employed by other groups like the far right wing to try and shift the blame.
The letters had some strange qualities. They were written in a strange German that used big, sophisticated words, but had basic grammar mistakes, as if someone was native German speaker but pretending to be a foreign person.
Federal investigators have detained one man suspected of links to Islamist terrorism, one of 2 suspects whose apartments were raided this morning.
Shortly after the bombing, a man in Austria named Rudolf, who was a big BVB fan, he noticed that something strange was going on the stock market related to the team's shares. He emailed the lawyers of BVB, who then forwarded that email on to investigators. The email stated that someone had bought 60,000 BVB put options, a wager that the value of the shares of the team would fall below a certain amount at a certain date.
Why would someone buy that ahead of a match and then 3 bombs go off? Something isn't right here.
For the person to make money off of that, it required the stock to go down quite a bit in a fairly short period of time. And it wouldn't just be the team losing a match, it would require something much bigger than that. There was another big red flag about this purchase, which is the fact that it had actually been made, number one, on the day of the bombing, but also from an IP address that had been traced to the actual hotel where the bombing had taken place.
When 3 explosions targeted the bus carrying the Borussia Dortmund footballers on April the 11th, written notes left at the scene claimed the attack was the work of ISIL. The truth, as is now alleged, is remarkable.
On April 21st, the police arrested a man in a southern German city called Tübingen. He was on his way to work, and his name was Sergei Venegold. He seemed like an unlikely suspect because he had no known connections to the Islamic terror world. He didn't seem like a far-right extremist. He didn't seem like a left-wing extremist either. He seemed to be a completely unremarkable young man.
A 28-year-old German-Russian man, named only as Sergei W., stayed in the same hotel as the players on the night before the bombing. He specifically requested an upper room overlooking the bushes where the explosive devices were hidden.
The media dissected why he would do that, what was his past.
He had been inspired by the 2015 terror attack in Paris. And he noticed that in the aftermath of the attack, the stocks of French companies went down. And he believed that if an attack took place that was directed at a specific company, that the decrease in stock price for that company would be even more dramatic.
It never occurred to anyone that someone would do that out of greed.
We now know that the suspect bought 3 different derivatives on the Borussia Dortmund shares. With all these derivatives, he bet on falling shares. The suspect bought the majority of these financial products on the 11th of April, the day of the attack.
If the plot had been completely successful and the stock had reached a value of 0, Venegold would have made up to 570,000 euros, or the equivalent of about $608,000. Ultimately, the plan completely backfired.
The attacker, Sergei Venegold, didn't make any money. In fact, he lost money.
In court, he would be extremely quiet. He usually kept his hands clasped together. One of the lawyers actually commented that he had never seen a defendant act so calmly. Venegold had served some time in the German military. From that information and from online research, he was able to figure out how to assemble remote detonated bombs that would do what he hoped to do. There were a few days of extremely emotional testimony, including the soccer players who described doubting whether or not they could ever play another game again.
It brought everything back up, and it didn't quite help them to kind of process what was going on.
Throughout it all, he sat there completely silent. The big mystery that was swirling around the trial was the question of why he may have simply done it because he wanted to impress a woman. Rebecca is a young woman who has a very troubled home life. She ultimately sees her relationship with Weinergold as an opportunity to leave that troubled home. Weinergold is a Russian immigrant to Germany. He speaks with an accent. He has anxiety in large groups of Germans. She begins to resent the fact that he has these fears and feels a little bit trapped. Rebecca attempts to dump him on multiple occasions, and he threatens to commit suicide if she leaves him. Weinergold apparently told Rebecca that she would soon be seeing a surprise. After being dumped via text message, he apparently began planning for this attack in earnest. Weinergold was charged with 28 counts of attempted murder, which carried a maximum sentence in Germany of life in prison. He claimed that he had nothing to do with the attack, but as time went on, he admitted that he had actually been the person who had built the explosives and had set them off. But he claimed that he didn't want to actually kill anybody. Ultimately, Weinergold didn't receive the harshest possible sentence. He was given 14 years in prison, but it's still a considerable amount.
The threat of an asteroid hitting Earth is very real. If it's big enough, it's also very final.
These are very, very infrequent events. The probability is not zero, though.
A blinding flash of light streaking across the sky.
About 100 tons of space rock falls on Earth every day. Most of it is so small it burns up in our atmosphere or lands unnoticed away from major populations. No human in the past 1,000 years is known to have been killed by a meteorite, and according to NASA, no large object is likely to strike the Earth any time in the next several hundred years. However, one thing is certain: we haven't found them all.
There are thousands out there, and we don't know where they are.
There are a lot of asteroids in our solar system. They number in the billions.
Scientists all over the world are working toward detecting and deflecting the most catastrophic of natural disasters.
The race is on to find as many of these objects as we can.
We have a way of calculating whether or not an asteroid is potentially dangerous or not.
I mean, I think it's something worth investing in. It's our existence at stake, right?
Amy, let's get this one out of the way. It's probably the question you get asked the most, but how scared should we be?
Asteroids and comets are a natural hazard that's out there like a lot of other natural hazards. These are very, very infrequent events, these collision events where an object actually impacts the Earth. The most important thing that we need to know about asteroids is when the next impact is going to happen and how bad it will be. What we know is that an object that's about, say, a kilometer across is capable of causing very, very wide devastation across the planet, really, truly global devastation. The object that wiped out the dinosaurs was somewhere in the neighborhood of 5 to 10 kilometers across, so even bigger than that. At a kilometer, it's still going to be very bad and will have global effects. For objects that are capable of causing what I would call sort of regional damage, kind of a large major metropolitan area, a city and its surrounding environment, sort of around 100-ish meters. It depends on the details of the composition and so forth.
By the 1980s, NASA was cataloguing near-Earth objects. In 1994, stargazers watched as comet Shoemaker-Levy 9 hit Jupiter. The resulting zone of chaos was estimated to be as large as the Earth, and the event became a turning point in the search for asteroids and comets in our solar system. In 1998, Congress tasked NASA with finding 90% of asteroids and comets 1 kilometer wide or larger. Soon after, Hollywood blockbusters Armageddon and Deep Impact brought attention and fear to the masses.
The great news is that the vast majority, more than 90% of all the really large 1 kilometer near-Earth objects have been found. The challenge now is working down to these smaller sizes that are still quite capable of causing a lot of damage, but they're just harder to spot because they're fainter, they're smaller.
Can you give us a sense of how many are out there in our solar system?
We know that there are a lot of asteroids in our solar system. They number in the billions. Most of them, however, are between Mars and Jupiter in what we call the main asteroid belt. This is a region of space where most of the asteroids in the inner part of our solar system live, and they stay there for many billions of years. There is another population, though, that kind of leaks inward and gets into the region somewhat close to the Earth, and we call these near-Earth objects. We think that there are millions and millions of near-Earth objects that are out there in the total population. As of today, we know of sort of around 20, 25,000, something like that. When we first spot an object, we really know very little about it. We just see something moving across the sky. So all you get is just sort of a handful of snapshots, just enough to be able to tell that this isn't an asteroid that we've already seen before. And then once we can calculate the distance to it, we can now start to make predictions about its true size. Is it large or is it small? So we have a lot of information that we have to get pretty quickly to really understand what's going on.
Finding asteroids is just one piece of the puzzle. Planetary scientists are extremely skilled in determining the orbits and speeds of asteroids based on relatively small amounts of data. NASA runs simulations of the trajectories asteroids could take, which is useful but time-consuming. A team of scientists in the Netherlands have found a way that could buy us more time.
Our method is very quick. So you can very quickly get an assessment of whether or not the object is dangerous or not. If you look at the classical way of determining the danger of an asteroid, it may take days of computing time on very big machines to determine this hazardousness.
The current problem is that there's just too many asteroids out there to spend a huge amount of computational power on all of them. So the neural network allows us to focus on what really could go and pose a hazard to Earth.
A neural network is a computing system that mimics the way the human brain operates to find underlying relationships in a set of data.
By training the network in this way, you train it in recognizing those objects that are most likely to hit the planet. And once it's trained, you can apply this network to all the unknown asteroids. And then you can make a selection and saying, hey, these are the ones which appear to be having orbits similar to the ones which we know are hitting the planet. That doesn't mean that they do, but it only means that they look very similar to the ones we know they do.
What else did you find? Should we be particularly concerned about anything?
One thing that we did find is that our neural network was able to go and identify a handful of asteroids which weren't considered potentially hazardous, that when we went and integrated them forward in time, they came quite close to Earth.
We find a handful which were not detected before or not considered being dangerous before, and we think they are potentially dangerous.
It's very hard to simulate kind of going forward in time an asteroid that's going to hit Earth because, well, the Earth is really small. And space is really big, and then you have to have very exact parameters to shoot an asteroid that goes and hits exactly Earth. And then Simon had the ingenious idea of not even trying to do that and just launching the asteroids from Earth's surface and integrating backwards in time.
It's very hard to make it hit. So you need a lot of calculations which all end up in nothing. And the idea was then like, well, let's not do that. This is basically what NASA is doing. NASA is taking an asteroid, making multiple copies of them, shooting them all forwards in time, calculating their orbits, and then see what fraction sort of gets close to Earth. Not even hitting Earth, but getting close to Earth. And that they call it a potential impactor. So you calculate the solar system forwards in time for, let's say, 1,000 years. And then you launch asteroids from the surface as if they, if you go forwards in time, would fall on the surface. You calculate them backwards to today, and then you get your orbital parameters of today's asteroids, which you know will land on the planet. And those you can use as known impactors and compare with all the other asteroids in the solar system.
Can simulations and AI, can those things fill in the gaps where perhaps telescopes and other imaging tools can't?
Absolutely. Since the observations get more complex, the physics gets more complex. And if the physics get more complex, the mathematics becomes more complex. And at some point, you can't solve your problems analytically anymore. And then this is where the computer comes in. Now we have this trained neural network. We have a way of calculating in a fraction of a second whether or not an asteroid is potentially dangerous or not, and therefore deserves more attention or more time to spend on for really finding out if it is dangerous.
When it comes to hunting asteroids, time is critical.
What we can do about a potentially hazardous object depends a great deal on what we know about it and how much time we have before the encounter. We'd really like to find them when they're decades away. Because the more time you have, the more options you have, and the less energy it takes to move an object aside.
It also means we might not have to resort to launching a nuclear warhead at an asteroid. Until recently, pretty much our only choice.
That's an option of last resort, in my opinion, yes. We have lots of options available. You can just simply bump into the object and just nudge it out of the way. That's one possibility, and that's kind of, in a way, sort of the simplest thing to think about, just nudging it off its path a little bit with, a massive object, a spacecraft, let's say. It's just kind of like bowling, if you will. If you have a long time or a long stretch of runway in the lane, just a very small twist on the bowling ball will make a big change in where it ultimately ends up. Another option would be something where you take a very big, massive spacecraft and you park it next to the object and you use the force of gravity as a towing rig. That takes longer, though, and you need to be able to send a pretty massive spacecraft, and it obviously depends a lot on how big the asteroid is. Other options start to get more and more complicated, and they range from painting one side of the object a white color and painting the other side dark, and then letting the pressure of light sort of perturb its orbit.
In a departure from the lab and computer simulations, NASA has real plans to rehearse kinetic impact deflection. In 2021, the agency will launch DART, the Double Asteroid Redirection Test mission, which will intercept a 160-meter asteroid in 2022. Better to practice now before we have to deal with an actual threat. In the meantime, discovering asteroids is our best bet. Thousands of scientists and amateur astronomers around the world make up an informal network that survey the heavens. But that may not be enough. NASA wants more resources to map our solar system and better technology.
We need to ramp up our network of sensors, and also we need to just continue to strengthen our network of international observers so that we can get follow-up, because we find these objects when they're distributed all over the night sky.
Once we get more observations, we get better data, we can make better predictions.
If you look at the big impactors we have had in the last, let's say, 20 years, or maybe 30 years, or 50 years, most of them we haven't seen coming. So the real danger, I think, comes from the objects we don't know about, and not from the objects we do know about.
This particular natural disaster, like a lot of natural disasters and like climate change, is a problem of the global commons. So the thing that we risk collectively is that it sort of then becomes nobody's problem, and nobody takes ownership over it. The asteroids are all over the sky. They just truly cross boundaries and borders with a second's notice.
I kind of imagine in the future, maybe lots of small satellites around the Earth that are always going and looking outward. I mean, I think it's something worth investing in. It's our existence at stake, right?
pandemic has affected everyone in different ways. Some pass the time by baking.
Homemade sourdough bread. Do I need to say more?
Some chose to binge watch Netflix.
It's your game.
Or maybe you started a garden oasis in your backyard.
Next, I'm going to put my lettuces in.
But for millions of others,
I'm going to be posting stocks that will boom.
They wanted to uproot the financial industry.
Let's just lock it on up and take $15,000.
Here's a stock that can change your life.
I see a stock going up and I buy it, and I just watch it until it stops going up, and then I sell it.
I have gained over $3 million.
I want some free money.
I don't think you can overstate the online communities or social media's influence on financial markets.
A large group of inexperienced investors who discuss their plans on social media platform Reddit have shaken up the stock market in a big way.
The stock that everybody's talking about right now is GameStop.
Video game retailer GameStop is set to continue their head-spinning ascent today.
The revolutionaries on Reddit are spanking Wall Street's ass.
The more these stocks go up, the more the big guys are getting creamed and losing billions of dollars.
This isn't a wealthy person's game anymore. Anyone can play it.
I took up a little bit of a new hobby, and I am interested in day trading.
As an investor nowadays, you don't have to look a specific way. You don't have to wear specific clothes. You don't have to be doing it from a trading floor on Wall Street in like a high-rise building in downtown Manhattan.
The narrative of what's driving the markets is no longer being held in secret offices in New York and Boston of privileged people talking to other privileged people. It's right out in the open. It's on Twitter, it's on Reddit.
From brokerage apps to Discord channels and subreddits to TikTok finfluencers, one of the last holdouts in the world of disruption, finance, is next in line.
Investing should be as ubiquitous as shopping online.
That's Vlad Tenev, the CEO of Robinhood, the online brokerage app, talking about how he wants his app to disrupt the world of stock trading like Amazon disrupted the world of home shopping.
And I think that speaks to exactly the mission that a platform like Robinhood has, which is to democratize investing.
Robinhood was started in 2013 by Vlad Tenev and Baiju Bhatt in, where else, Silicon Valley, as an alternative to the big brokerages, but with one big difference.
As they were building the social network around finances for people, they realized that there was a gap in the market and that free trading could become something that they could bring to the markets, they could disrupt the industry.
While no-fee trading is industry standard today, it was unheard of when it was first introduced.
The online brokerage industry was really innovative when they came on the scene 10, 15 years ago, but they kind of stopped innovating where you haven't seen those commissions come down beyond $5 or $6 or $7. Robinhood think that by offering zero commission that they're going to push people onto this platform.
And on top of no-fee trading, the customers Robinhood was courting have been long overlooked in the world of finance.
So the typical customer of a Charles Schwab, for example, is putting a lot more money in that brokerage account than the typical customer at Robinhood. Even today, with all of its popularity, the median account size is about $240.
There's Fidelities and the Schwabs and the E-Trades of the world. They look down their nose at those kind of accounts. I don't want a $1,000 account. They're just a headache. I want a $100,000 account.
And this is key here, right? Because the thing about Robinhood that's different than every other single brokerage platform is how easy it is to use.
The design of the Robinhood app really has in mind a user who might be coming at this absolutely cold.
The fonts are very well sized, the shapes, the colors, all of that is something that the founders of Robinhood paid really close attention to.
And by creating an interface that catered to a newer investor, they were able to gather a pretty healthy group of customers. And by 2019, they had about 10 million customers.
Those 10 million customers were a huge success story for Robinhood, but no one could have predicted its explosion after the arrival of COVID-19.
Remain indoors to the greatest extent
and 100% of the non-essential workforce must stay home.
What we saw when the pandemic hit was the growth of Robinhood users absolutely turbocharged. And oddly, you saw this surge in interest in stock trading. Then they saw the absolute surge in 2020 in customer growth. And now, by many accounts, they have more than 20 million customers, which is pretty extraordinary. So the next step for them is to figure out how to monetize those users and how, even with their small account sizes, to get them to grow with the company and, as it releases more products, come along with them.
Robinhood would become one of the COVID economy's breakout successes. Robinhood traders, as they're called, became the shorthand explanation for the frenzy of often speculative retail investing after the pandemic lockdowns.
Kids wake up in the morning, they go on Robinhood. They're, in the shower, they check Robinhood. Kids are learning how the stock market works at 18 while they're at school, checking their phones in between classes because notifications pop up telling them what their stocks are doing that day.
With these new tools, millennials and Gen Z are investing in the market in ways their parents could have never even dreamt of.
That is sort of key when we talk about the divide between older and younger generations, is that the younger generation is exposed to so much more information and tools at their disposal to do what they want in the market.
The older generations, you never had the technology or the cost structure that you could play the markets like you can today. So you were stuck with giving your money to a professional investor and paying them a fee to do it.
When I speak to young kids, they tell me, I'm making mistakes, I'm losing money. I'm not a perfect investor, but I'm 18, and by the time I'm 30, which will be, 10 years from now, I'm gonna have interacted with the markets for a decade. And so it's a learning experience more so than anything else.
And you can look at it and you can say, wow, that's risk-taking, that's dumb, but if you could possibly shave 10, 20 years off your working life versus adding 5 years, I don't think you can fault people for that.
But Robinhood is only part of the puzzle. Sure, you can trade on it, but without research, information, and data, you're just blindly throwing darts at different stocks and hoping to strike it rich.
Wall Street forever has always run on what we now call narratives or memes. People telling rumors to each other have been around for 100 years.
On Wall Street, information is its own currency. Historically, either you had it or you didn't. And the people who had it had a huge advantage.
In the past, those narratives and memes didn't have a network effect. It would be one person telling another person over the phone. In fact, when I broke into this business in the 80s, a lot of people used to complain that they weren't on the call list to get those ideas.
Social media changed all of that.
Fast forward to 2021, that's being done on the internet now. And that's being done on Discord and Twitter and StockTwits and Reddit. And the impact is very similar, but orders and orders of magnitude larger.
As social media has played a bigger part in our lives, it's also played a bigger and kind of more important role in how people find investing ideas online and on these platforms.
How do those ideas spread? On TikTok. Yes, that TikTok.
Soon may the weatherman come to bring us sugar and tea and rum.
People aren't just going to it for sea shanty videos.
The personal finance hashtag on TikTok has garnered 3.5 billion views from its 1 billion monthly active users. By comparison, videos found under the cooking and health tips hashtag have 2.6 and 2.1 billion views respectively.
The trajectory of Robinhood and TikTok were literally on par.
What happened in the stock market this week? So the word of the week is expectations.
Absolutely essential that you guys understand the risks of shorting.
And Kayla Kilbride and Kyla Scanlon are two of those financial influencer TikTokers, also known as finfluencers.
I think people still care about fashion, they care about culture, but it's also like there's this big behemoth thing called the stock market that we really don't know a whole lot about, and it's gatekept behind the industry. And so people like want to unpack that. And so my audience is, a lot of them are younger investors who are looking to hone their skills.
Tech and right up.
Kyla and Kayla are two of the more, let's say, professional TikTok influencers.
The Tesla ARK Bitcoin Biotech Risk Cluster.
I've been trading since high school, and it was a really interesting way for me to fill out my decision-making frameworks and to think about thinking. And I think that the more that we can have people thinking about finance, the better that we're going to progress as a society. I think it's a huge gap in our educational system.
If you're going to buy an option for a stock you think is going to go up, it's a call. So think of it like this. I made the options video where I was like, options are just like shopping. Rumor has it that this pallet's about to go up in price. So if I come in tomorrow, can I still buy it at said price? And a ton of women just like attacked that video and were like, you explain things so much better than my boyfriend or my professor, or like I could sit and listen to you all day. And I was like, this is what I was looking for.
But TikTok's algorithm does not reward calm and measured videos about responsible investing. It rewards this.
Watch this video for 30 seconds and you'll be rich for the rest of your life.
I try not to say the A word, the ALGO word, because TikTok listens to us.
The algorithm does impact how you feel. You know, you do notice which videos do better versus which videos do worse.
How do you catch someone's attention in less than 60 seconds? And how do you make it something that they're like, I need this in my life? Nearly impossible to do that in 60 seconds. But the people who perfect it are the people that you're going to watch and going to stick around.
And where people are sticking around? Reddit. And its nearly countless subreddits about finance. And by far the biggest one of those is Wall Street Bets.
There's a lot of social media platforms out there, but Reddit is like the social media platform for finance. Places like Wall Street Bets is where it all goes down.
Started in January 2012, it wasn't long before Wall Street Bets adopted a 4chan-like etiquette, leading to their tagline, like 4chan found a Bloomberg terminal.
We had all these unexplained stock moves, and we would be grasping for why stock XYZ jumped 20% in a day. And you would look at Wall Street Bets, and you would see people there talking about buying options in that stock, and it sort of, squared the circle, so to speak, and started making sense. And it was at that point that it was like, wow, we have to start paying attention to this.
Some people on the platform really spend tons of time, and others are just looking for entertainment and to have a little bit of fun, effectively gambling or looking for an outlet, trying to make a little bit of money.
Then on top of all of that, there were stimulus checks. Now, clearly this money is going to people who need to use that to eat, to live, but there's a lot of people who use this money to invest in the stock market.
And it's not just stock tips. People quote-unquote YOLO their entire life savings or stimulus checks on a single stock. They post what is called gain and loss porn, screen-grabbing staggering hits and misses on stocks for the entire community to see.
I'm about to lose everything.
And while some of the people on Wall Street Bets are novice investors, the community contains multitudes.
In one respect, what it did show us among these network groups is they are very sophisticated. They're not a bunch of ignorant people talking to other ignorant people.
And this is where the pieces of the puzzle all come together to wreak havoc on Wall Street for a solid week in early 2021.
It's pretty clear that the combination of more people having retail brokerage accounts and trading apps and more people being stuck at home looking for some kind of entertainment and some kind of community online came together in this very singular way.
What came together is GameStop.
Let's go back to the beginnings of what happened with GameStop a couple of years ago. On the boards like Reddit and StockTwits, a lot of people were talking about GameStop as being attractive value.
Some of them are even, Wall Street alums who left the industry and now still have access to tools that they can use to improve their financial well-being and make very good decisions. And I think Roaring Kitty is a perfect example of that.
GameStop is one of the most compelling asymmetric opportunities in the market today. Really, I don't understand how you could disagree with that.
At the same time that this crowd was talking it up, the hedge fund institutional crowd didn't like this stock at all, and it had the largest short interest of any stock in the New York Stock Exchange going into late 2020.
Short selling is a bet that a stock price will fall, and it's a fairly simple concept. An investor borrows a stock and then sells it. The investor is betting on buying the stock back later for a lower price before returning it to the original owner, pocketing the price difference.
What a short seller would tell you is that they almost act as a policeman in financial markets, or they're at least looking for companies that aren't what they say they are. And that can range anywhere from an outright fraud that some short sellers try to expose to just a company that's not worth as much as investors think it is.
The problem is, if the stock price rises, the short seller has to come up with the money to buy the stock back. And the more it rises, the more it costs. And that's what's called a short squeeze. And the hedge fund Melvin Capital was on the wrong end of that squeeze.
Melvin Capital lost over 50% of its money in the month of January alone, just from being caught in the short squeeze of the stock.
This is where the disruption comes in.
One of the most wild stories you're ever going to see. GameStop shares absolutely going nuts.
In less than a year, the company's stock has jumped from less than $3 a share to almost $350.
Cheers, everybody!
Roaring Kitty has turned $50,000 or so investment into some $14 million.
Whoa!
Investors all over social media use the free trading app Robinhood to wreak havoc on Wall Street.
They're actually piling on into some of these stocks to really hurt the professional short sellers.
And they all used Reddit, Twitter, TikTok, and Discord to tell one another to keep buying and, quote, hold the line and not sell GameStop.
People are getting cheerleaded for jumping in, buying at the highs. They're saying, keep going.
And it was working too, until
Thursday morning, the trading app Robinhood sent out this tweet. In light of current market volatility, we are restricting transactions, including GameStop.
People were really angry.
Robinhood was supposed to allow the regular people to play the same game these big boys are playing. But instead, we were all taken for schmucks, and they screwed us.
Shares of GameStop are jumping again now that retail investors are being allowed to buy shares of the stock.
But what we learned is that when people organize online, they have the ability to disrupt the market.
And it was a big sign. The ivory walls of the institution aren't as powerful as maybe the institutions thought them to be. I don't know if pumping up GameStop was the best use of billions of dollars, but I think that as a signal to society, it was pretty interesting and powerful.
The GameStop saga was so impactful that both Vlad Tenev and Roaring Kitty were called in to testify before Congress to clarify each of their roles in the saga.
One thing that's emerged from the congressional hearings is that they're interested in how retail brokerages make money and whether they're keeping the best interest of their customers in mind, but it's pretty fuzzy as far as what they would actually do as a result.
While the frenzy around GameStop eventually subsided, it didn't take long for retail investors to find other areas to invest their money.
Take a look at Bitcoin going bananas over the weekend.
Bitcoin forms a brand new all-time high.
It was after GameStop started to drop that we saw Bitcoin really go up to over 60,000.
How much further does this rally have to run?
It's compelling to say that money shifted from one venue to the other.
While correlation doesn't equal causation, there's a chart out there showing an inverse correlation on meme stocks going down and cryptocurrencies going up.
There's definitely an aspect where people are making money on stocks and then moving, they're agnostic, they're not hedge funds. They can invest wherever the hell they want. It's a classic sort of momentum trade. They're going to wherever the winners are and they're willing to jump on and, ride it.
So whether it's meme stocks like GameStop, Meme coins like Dogecoin, or entirely new ways to invest in art like NFTs, the new kind of retail investor is making its presence known.
Over the next 10, maybe 15 years, you're going to continue to see, whether by choice or by force, that baton go from older generations to younger generations. I don't think any single app is going to be the thing that disrupts. I think people are the disruptors.
How people get ideas about what to invest in has become increasingly entwined with social media. And as social media companies govern more and more of our lives, the fact that now they're tied in more intimately to people's wallets is something that we might want to understand better.
Usually what disruption, I think, means is technology comes in, whether it's blogs to the newspapers or online retailing to brick and mortar. They come in and they're in the same business, but they just do it in such a gigantic cost savings that it causes everybody to switch. Well, that's the risk that happens here, is that it's so much cheaper to just manage your own money. We're not there yet, but costs and conveniences are moving in that direction. So I'd say, Wall Street, you haven't been disrupted yet, but you could be in the coming years, and that the final chapter on this story hasn't been written.
Meet Bloomberg's own David Nicholson. Now, his happy place is out in the field, on the open road. But like the rest of the world lately, he's been working from home a lot more than he's used to. COVID-19 has prompted a massive urban exodus as professionals of every ilk yearn for more space to live and work. As a result, rural areas have exploded, and they're poised to experience a resurgence as more and more families pack up and leave the big city to try out life in the burbs. But there's one problem with that. Not all internet speeds are created equal. Anyone who might need to upload or download large files for a living may not want to pack up and move to that cabin in the woods just yet. Now, David's house isn't a cabin, but it is in the woods, and inexplicably, his internet is workable.
My internet is okay. I pay a lot for it. It's around $140 a month. The download speed's great, and the upload speed is terrible, which is really bad for my work because I have to upload these massive files. But I'm definitely one of the more lucky ones in this community. Just a few miles down the road, my buddy has awful internet.
It's usually under 2 down and under 0.2 up, so it's often unusable.
Some days it's around 1, and other times it'll drop down to about 0.2, 0.3.
I just want to be able to have internet at my house without having to go outside the normal ways of acquiring internet. It's really frustrating.
We're literally miles, a few miles away from downtown, and it just cuts off.
This is a problem, and the solutions are not there yet, because getting high-speed internet in rural areas en masse is something our providers may simply not be ready for.
If your internet service doesn't have fast download and upload speeds, then you don't have high-speed harmony. You have.
Americans on average pay about $70 a month for internet at home. But in rural areas, it could cost a lot more for a lot less service.
So the pricing for a fixed wireless provider here can be something between $80 and $150 for about 25 megabits per second. However, gigabit service, which is 1,000 megabits per second and symmetrical, is running at about $119 a month or $130 a month.
That's John Paul. He co-owns Spiral Fiber, an internet service provider here in Nevada County, California. And for the past 10 years, he's been trying to bring an affordable fiber optic network to town. It all started when he applied to be part of the pilot program for Google's fiber service.
Across the country, civic boosters have been going to extremes, chanting, singing, Google in the morning, and marching, trying to get the search engine giant to look at their town.
The internet these days is crucial to be in the world, to be a part of the world, and to be connected to your community.
Google ultimately went with Kansas City, Missouri, which left Paul on a mission to get funding to lay out fiber optic networks for gigabit service. Over the next several years, he would attend conferences and pitch venture capitalists and apply for grants to make his vision come to life.
One of the biggest roadblocks to building infrastructure for the internet here in the United States are the existing large providers. They have their land staked out. They would prefer that nobody come in and compete against them. In 2013, we applied for a grant. We went down and met with the commissioners at the California Public Utilities Commission. It was an arduous process to get funded, but we finally did against all odds. We got a $16 million grant, and then we went out to seek venture capital.
Then, in March of 2020, the pandemic hit the world.
Everybody got locked down, and everybody came home, and everybody started using the internet. And I remember seeing on one of the local fixed wireless providers' websites, they've said, hey, we know you're all staying home, but please don't use too much video, and please don't use too much bandwidth. And I thought, that doesn't work.
The U.S. connectivity gap is far greater compared to countries that are considered its peers economically. Some developing nations actually have better internet than rural America, like in Kenya, which has a state-of-the-art fiber optic network fed in from their coastline. The American connectivity gap does largely affect rural areas that are either outside of service coverage or simply prohibitively expensive. This is Rebecca. She and her family moved to Nevada County just a couple miles down the road from David. They took for granted that high-speed internet would just exist in the area, and it's not something they even bothered to check on before buying their house. Turns out, all they got was dial-up.
We wanted to move where we had a little more space, room for the kids to run around, just be out in the mountains a little bit more. Having come from a bigger city area where Wi-Fi is pretty readily available, we hadn't really considered that in our purchasing of the house, whether that would be an option or not. When school started, and now that we are remote learning with our children and we're doing everything from home, we didn't have the option to do that at our house. So every day when school would start, we'd have to pack the kids up and we'd go to my in-laws' home. They have a little cabin up in this area that does have Wi-Fi already.
Rebecca's situation is the norm in rural America.
According to data from the Federal Communications Commission, just 4% of urban Americans lack access to broadband internet. That's compared to almost 40% of people who live in rural areas. While that was the case, there were also racial and socioeconomic divides in terms of who had that access. In addition to that geographic difference, low-income African-American students, Latino students, and first-generation college students were more likely than others to have only one device at home that's shared among multiple siblings and or lack access to that actual connection.
For most American towns, there's also a lack of competition, forcing internet prices up. And large providers like AT&T and Comcast aren't incentivized to expand service to these rural communities.
This is how Xfinity makes life simple, easy, awesome.
So in our area, we have a small imprint of Comcast, but they're not going to go out to the more rural areas. It's just not cost effective for them to do it as a large company.
In order to lay fiber cable, you're actually physically digging trenches into the ground. And for internet service providers, they're primarily focused on maximizing their profits. And so the fewer customers you have, in any square mile and the more fiber you have to lay, that's just kind of harder to pencil out from a purely economic standpoint.
AT&T released a statement on the matter, expressing the need and desire for government assistance to fund fiber optic expansion to areas deemed unprofitable. Comcast released a similar statement encouraging more public-private collaboration on this effort. Federal agencies do offer grants to help communities build broadband networks, but many have argued that there's not enough flexibility on how to use these funds. The COVID-19 relief package passed by Congress in March and signed by President Donald Trump awarded $43.3 million to 51 projects on the East Coast alone. But it also stipulated that these projects needed to be up and running by December 30th. For contractors who plan projects months and years in advance, it's a scramble to rearrange their schedules to meet that deadline.
So what we've been asking the federal government to consider is at least have, as long as the projects are getting started, knowing the projects are being put into place to expand both remote learning, working from home, and opportunities like that that are truly driven from COVID. We're moving as fast as we can regardless, but hopefully they'll give us some more time.
Talking to John Paul, it's clear that he believes broadband is something that can transform a community and should be considered a public good.
One of the first communities to come on in the United States with full-on gigabit service was Chattanooga, Tennessee. Now, they're a bigger city, but they're a city that was economically in a downturn. In the last 15 years, the city of Chattanooga has turned around in an amazing way. It's a nexus for young people to move to. It's a place where technology happens.
It's not just about logging on to Zoom, to connect with your colleagues who might be in New York City. It's also your ability as a small business, operating in the town of Nevada City or wherever it may be to, quickly upload your payroll documents or something onto the cloud, or to quickly, swipe a customer's credit card. There's just some really basic business functions and mechanics that I think people in big cities really take for granted, and that are just going to be a much bigger challenge for small business owners in rural areas.
Historically, the marginalized people, you call them as untouchables or Dalits, they have been kept away from the center of the knowledge. Once you are born into a caste, it is very difficult for you to grow beyond that. You are stuck in that identity. I think education is the best way of liberating them. So that's how I chose to work in education sector. The kind of education that we are giving to the marginalized people is going to change not just the fate of these communities in Telangana, but it is going to be the source of inspiration, source of hope for all the marginalized in this country.
Greatest blight in India is the system of caste.
For generations of Indians, the social code known as the caste system has defined how people earn a living and whom they marry. Although outlawed 7 decades ago, castes remain a significant factor in deciding everything, from family ties and cultural traditions to educational and economic opportunities. Dalits, people who are on the lowest rung of the caste system, constitute almost 1/5 of India's population of 1.3 billion. Not able to afford the high tuition of private schools, many are forced to attend government-funded institutions, which in the past have suffered from poor infrastructure, lower education standards, and high student-to-teacher ratios. But Dr. Praveen Kumar is trying to change that.
I am currently working as head of Telangana Social Welfare Residential Schools. So totally above 400 schools I manage. These are all residential schools for the students who are historically marginalized but talented and then poor.
My friend also
Of them, 60% are girls and then 40% are boys, because girls are more marginalized among the marginalized. Their voices are always suppressed. My approach to improve the conditions in the schools has been put your eyes and ears on the ground always. Talk to the parents, talk to the teachers, talk to the students, stay in the schools and then understand their problems, their challenges, both in classrooms and then the corridors and the dorms. Then go to the dining halls and see what kind of food they are eating, and then go to their homes and then what kind of food they are getting and what kind of challenges the parents have. One of the important changes that I brought in after I took over was to complete the transformation of mother tongue to English medium, because English medium, as I said, English is the language of emancipation, a language that connects you to the whole body of knowledge in the world. So we had to train a lot of teachers.
Refer to the dictionary also, okay, and find out